was on CNN last week and said Johnson, quote, has some tough decisions to make. But ultimately, Jeannie, it's going to be decided who President Trump likes. Is that the real contest?
I think it is. I think if Trump comes out publicly in support of Johnson in the short term, he will become speaker. Who knows how long that will last. But, you know, there is a lot of push from the MAGA conservative base. We heard Steve Bannon repeatedly, the latest out at Turning Point in Arizona over the weekend, dump Johnson. We saw the Hill article where you have a lot of unnamed sources saying where you have Republicans going down to Mar-a-Lago telling Trump to dump Johnson. I think a few things, again, working for Johnson. Number one is what Rick was just talking about, which is the chaos for Donald Trump if they do indeed dump Johnson. There is a scenario in which if they don't have a speaker, you see Joe Biden, Kamala Harris step aside, and President pro tem of the Senate, Chuck Grassley, actually becomes the president in a short term. Now, many constitutional experts say that won't happen. It's a gray area. There can be an agreement in the House between the Dems and the Republicans to count those votes. But I'm not sure that's how Donald Trump wants to start out his second term. And so that, I think, is going to work for Johnson. But, Joe, for us, it's going to be a whole lot of fun. Sort of. Not
we'll see about that. I just love Jeannie has played this whole thing out in her head already, Rick. My God, could be fascinating. But you're right. Steve Bannon says he's got to go with regard to Mike Johnson. But, Rick, we keep hearing that nobody else wants the job, which is, by definition, job security for Mike Johnson. Is that right?
Well, I think every member walking around the floor, both Democrat and Republican, want to be speaker. Don't believe what they tell you. It's a powerful job. You get to make a lot of decisions. Sure, you know, it's a tough thing to corral a caucus. But, you know, Stephen Scalise and others are going to be ready to step into the breach if there's a vote of no confidence.
You wonder about a Jim Jordan or a Steve Scalise as Speaker, Jeannie, but didn't we already try that just this year?
We did. We did in the 118th and again this year. And you know what? How about we look outside the House? What about Donald Trump Jr.? Or, well, Elon Musk is falling out of favor a bit with the MAGA right, but who knows who it could be at this point? Maybe Laura Trump. She doesn't want to be senator of Florida. Maybe she wants to be speaker.
I don't even know where to go with this. You know, I show up with things to ask Rick and Jeannie. We go down another path. So if I have this straight here, Donald Trump is the Speaker of the House, and the senator from Iowa is the president. Jeannie, is that what we get in the new year?
Well, maybe, yeah, Donald Trump Jr. and then Grassley, you know. So, I mean, who knows? Let's hope it doesn't happen. But it is going to be crazy to watch because being Speaker of the House is really a short-term job at this point, and it has been for, you know, several cycles going back now. It is a job that even Mike Jordan is saying or Mike Johnson, sorry, is saying nobody wants to have. So he'll just stay
Freudian
there.
Slip on that one. Rick, can we settle one question right now when it comes to the order, the sequencing when it comes to legislation on Capitol Hill? Do you do the border first? Do you do tax cuts first, or do you do them together? It seems to me with this argument that's underway today over H-1B visas, we have our answer. What do you think?
Yeah, I think you go with what is the easiest thing, right? And we know how complicated and difficult immigration is going to be, but it's easier than the tax code right now. And so you're going to need some time to prep that, and they're going to want a bill on the floor in the first 60 days. And the one that can get there is immigration. And it sounds like, based on all the rhetoric that's coming out of Mar-a-Lago, could be more comprehensive than we would have initially thought. So, you know, cross your fingers, hope to die, stick a needle in your eye. You may actually have comprehensive immigration reform at the hands of Donald Trump. You know, Nixon was the only one who could go to China. Maybe Donald Trump's the only one who can actually solve immigration reform.
Unbelievable, yet entirely believable. And this is what we're going to be talking about with Rick Davis and Jeannie Shanzano in the new year. Our signature panel, Bloomberg Politics contributors, thank you both. Great to have you for a great conversation today, as always. I'll be back in the mix, of course, next week as we walk up on that new Congress and the new year. We're going to get back to the situation in Ukraine and what's happening on Wall Street next. A conversation with Melinda Herring from the Atlantic Council right here on the fastest show in politics, Balance of Power. I'm Joe Matthew in Washington. This is Bloomberg.
There is no backwards in recycling. There is no backwards in treating pollutants in the water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services even in time of crisis, as well as to see the long term and deliver good result, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Thanks for being with us on Bloomberg TV and radio. I'm Joe Matthew in Washington. This is Balance of Power, the fastest show in politics. Rounding out the week here with our eyes on Wall Street, we are going to get to what's happening in Ukraine and an important conversation in a moment with Melinda Herring at the Atlantic Council. Some concerns about Ukraine moving into this winter in its war with Russia. But it's Wall Street that we want to start with here. Not good today as we round out the week with some pretty significant losses. We've seen worse numbers, but not by a lot. As the broad stock market heads lower, along with crypto and volatility rising by way of the VIX. Bloomberg's Natalia Knijevich is with us from World Headquarters in New York. Natalia, what are you looking at today?
So yes, we do see a lot of red across the board. NASDAQ is the biggest underperformer. The index is now down by 1.9%. Nevertheless, it erased some earlier losses. We see all big tech stocks are in the red today. It's really hard to find the reason. We don't see any big fundamental news, maybe just some profit taking. Some traders also told me that we should keep an eye on pension funds. We saw about 21 billion selling across U.S. equities, but it shouldn't be a big surprise because typically markets are positioned for that, and it's already had been expected. Now, moving into the bond market, we see that Treasury yields are moving higher. 10-year yields are now hovering at around 460. The VIX, the volatility index, this is where the biggest move is today. We see that the VIX moved to around 18 at one point. Now it's hovering at around 17. It was at 14 yesterday. And of course, cryptocurrencies, we see that Bitcoin is moving down for a second straight day. We keep an eye on big options expiration day today, more than $14 billion of contracts in Bitcoin expiring today. It always amplifies volatility in cryptocurrencies more specifically. And then we also see some volatility across commodities. Oil is moving down because stockpiles here in the U.S. Were down by more than expected. Then in natural gas, it's a little bit different story. We see that U.S. net gas is moving lower due to milder than expected weather, and European natural gas is moving higher on headlines that Russia will not be able to extend contract of natural gas via Ukraine by the end of this year, and there is a lot of uncertainty how the story develops next year.
Yeah, I'm glad you mentioned energy, Natalia. We were talking to Bob McNally a little bit earlier this hour at Rapidan about that story and just the broader sort of psychology when it comes to oil and gas ahead of the new year when the Trump administration will drill, baby, drill, and as promised, lower energy prices. But it's not always as simple as that. And I wonder what you're hearing from traders in the energy space today.
Exactly. The story is so much more complicated right now because now, for the first time in many years, we also see some divergence across energy, natural gas stocks versus oil stocks, because typically nat gas shares follow the direction of oil companies. But this time around, it's a little bit different because, for example, nat gas, and this is one of the biggest plays for traders right now, outperform oil gas. Like, for example, EQT is now beating oil giant ExxonMobil. That's a pretty big move. And there are a few fundamental reasons behind that. For example, with natural gas here in the U.S., first of all, it's more demand coming from Europe for U.S. LNG supplies. Secondly, some traders are saying that natural gas here can be the next AI play because there is more demand for natural gas coming from data centers because sometimes they are not able to secure more power coming from traditional utilities. And then on the flip side, oil is not moving high as some people expected earlier this year. WTI is down by 6% on a year-to-date basis, and this is mainly driven by concerns around Chinese economy.
Boy, there's a lot to cover there, Natalia, and we do appreciate your hand on this today. Natalia, on the markets from World Headquarters in New York, we thank you so much, and we'll see how things turn out here in the next 2 hours of trading. Just 2 sessions left in the year. How about that after today? Thanks for joining here on the Friday edition of Balance of Power as we keep our eyes on Ukraine, the story that Natalia was just talking about here with regard to natural gas, added to the story on the terminal that Ukraine risks losing all of the Russian land it seized in just a month's time. We're talking about the Kursk region, of course, where Ukrainian troops are facing off with not only Russian forces, but North Korean troops, bumping into some 12,000 North Korean troops in Kursk. Melinda Herring, of course, is an expert on all of this, and since the beginning of the war has spent quite a bit of time with us here on Bloomberg TV and radio, helping us understand the cross currents in Ukraine and what might come next. Senior fellow with the Atlantic Council's Eurasia Center. Melinda, it is great to see you. We know that Russia is using coal as a weapon. We saw the Christmas Day attacks, but this story coming out of Kursk is certainly one for concern. If it's Ukraine looking for a strengthened hand at the negotiating table. What is really going on the ground?
Hey, Joe, the Russians have decided that they want to push Ukraine out of Kursk before Trump is inaugurated on January 20th. So we're seeing a big push. I don't think that this is shocking or unexpected, but the Ukrainians have held this territory since August, and Vladimir Putin ignored it for a while. And then he decided enough with it, and they brought in the North Korean troops to try to push the Ukrainians out. So that's what we're seeing right now.
Well, there are a lot of challenges here. As I mentioned already, you've got the weather. We know about the equipment challenges, but then there's manpower as well, Melinda. And I wonder what the greatest need for Ukraine is as we head into the rest of this cold season.
Joe, so I think it's important to back up because a year ago, you and I were talking about ammunition shortages. And the ammunition shortages a year ago, last Christmas, were 8-1, 7-1, 5-1, depending where you were on the front line. That was Russian to Ukrainian. The Ukrainians were desperately short of 155 millimeter shells. They didn't have enough. It was a big panic. It was a big SOS. Fast forward to where we are now. There is parity, Joe, with ammo on the front line today. And there's parity with attack drones. So that's pretty remarkable, and I think it's worth acknowledging. But there is a manpower shortage on the Ukrainian side, and the Ukrainians sat too long on this problem, and they have a demographic crisis as well. So there's been a lot of pressure from the White House to force Ukraine to drop. Right now it's at 25 years and above is when men have to serve. And the White House in particular wants them to drop that age limit. But there's a big problem. If the Ukrainians drop that age limit, there's not going to be any more Ukrainians. Ukrainians tend to have children early. They get married early, have children early. And if they were to drop that age limit, it would really wreak havoc on the country.
Well, when you consider the need for material, if we can just focus on that for a moment, aside from manpower, Melinda, Elon Musk thinks that he's got an idea here. He says America needs a large quantity of long-range drones, air, surface water, and submarine, and hypersonic missiles. Anything manned will die very fast in a drone war. Is that what we have learned in Ukraine?
Absolutely. So that's one of the stories that definitely deserves more credit. And once the war in Ukraine is over, Ukraine is going to be the leading player around the world with naval drones and with long-range drones. And Joe, they have huge capacity. That's another story that's not getting enough play. So the Ukrainians in the last year have maxed up their drone capacity internally in Ukraine. And they could increase it by a 2/3 factor if they had more money. So it's really at this point, they don't have a technology problem. They have a money problem. But let's look at naval drones for a minute. So Ukraine doesn't have a navy, Joe, and the Ukrainians with naval drones have managed to push back the Russian navy to the other side of Crimea because their naval drones are so effective, and they're pretty inexpensive. So yes, the world has a lot to learn from what Ukraine has learned with naval and long-range drones. And also, it's not just the drones. It's the iterative process. Ukraine is able to test new technology in a matter of days, make changes, and then put it on the battlefield. And that's remarkable.
I want to ask you about what comes next. Of course, I always do, and we're going to be talking in less than a month here about a new administration. Donald Trump says, of course, that he can end this war on day one. We spent some time with the Secretary of State, Antony Blinken. My colleague David Gura asked him about Vladimir Putin's motivations, his intentions ahead of that moment. Here's what he said.
In his mind is the recreation of a greater Russia. And you don't have to believe me. Just read what he said. He's been very clear about it. He's failed in Ukraine. That proposition that he could erase Ukraine from the map, subsume it into Russia, has failed. And that's a result of the incredible courage of the Ukrainian people, but it's also a result of the dozens of countries that we rallied in defense of Ukraine.
So take what he just said, Melinda, and tell me how that meeting is going to go between Donald Trump, President Zelensky, and Vladimir Putin.
So, Joe, I'm not going to be very polite today. I'm going to just ignore everything that Blinken just said. It's simply CYA. It's him trying to say that they did a fabulous job. They did a B+ job, maybe a B job, but they're over. They're done. I'm sorry. Let's focus on January 20th. So January 20th rolls around. Donald Trump is coming in, and he says he's going to solve the conflict in 24 hours. Everyone knows this is a campaign promise. His team has put together 3 different ideas to bring peace to Ukraine. None of them are very concrete, but the most concrete plan is from Lieutenant General Keith Kellogg. He's going to be the special envoy on Ukraine and Russia. And the Russians have already said, don't even bother coming to Russia. If you come to Russia with this peace plan, the answer is no. So it's going to be very hard. Joe, the real question is, how do you get Vladimir Putin to come to the negotiating table? No one knows the answer to this question. Zelensky, the president of Ukraine, is willing. He wants to find a way to peace. But the problem is that Putin thinks he's winning. He's making progress in Kursk, as we talked about, and he's making progress in the Donbass as well. So my big question for Donald Trump and his team is, how do you compel Vladimir Putin to come to the negotiating table?
Well, yes, and I know you don't want to deal with Anthony Blinken here, but if what he said is correct, in Putin's mind is the recreation of a greater Russia, how do you get out of the blocks in any negotiation?
So the way that Kellogg says he's going to compel Putin to the table is that they will freeze NATO membership. That's sort of the sweetener to get the Russians there. And if the Ukrainians don't come, then they'll freeze military assistance. But the Russians have already rejected that. So, it's really, we're going to have this conversation after January 20th. And it's going to be a lot. I mean, no one knows, Joe, to be really honest. No one knows what's going to compel Putin to agree. I think it's right that Putin bet the house. He bet his legacy on destroying Ukraine. Blinken is totally right there. And he can't just step away from what he's done. And his legacy depends on him destroying Ukraine. Absolutely spot on right. But the question is, how do we get out of this?
Yeah, wow. I've only got a minute left here with Melinda Herring, but there is news today from, yes, this White House, John Kirby talking with reporters to say that another security package is being prepared for Kyiv. Do you have a sense of what would be in it? Would it be anything that could help?
So, Joe, the White House has done a very good job of trying to move as much military equipment from our shelves to Kyiv as possible, as soon as possible. And the fear is that Donald Trump is going to ice all U.S. assistance to Ukraine on January 20th. We simply don't know. Lieutenant General Keith Kellogg, who's going to be the special envoy, has been very hawkish. And when he comes on TV, he sounds like me. But he's not the decision maker. Donald Trump is the decision maker. So this White House is moving as much equipment as possible. The Ukrainians need air defense. That's the key to getting through the winter.
Well, take it from someone who does this for a living. There's only one Melinda Herring, and it's great to see you, Melinda. Thank you so much for being with us here from the Atlantic Council. As always, of course, Senior Fellow, the Atlantic Council's Eurasia Center, Melinda Herring on Bloomberg. We'll keep tabs on this story, of course, in Ukraine, straight through the inauguration. I'm Joe Matthew in Washington. Our conversation with Dame Karen Pierce, the UK's ambassador to the U.S. Transitions and even some bubbly coming up next on Balance of Power on Bloomberg TV and radio.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ही बुरा हो जाएगा।
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
names in business are on Bloomberg.
The question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are, and that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. We got to realize that the impact we have if we don't get this debt back in line.
Nobody covers business like Bloomberg. Context changes everything. Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
I did have dinner with Tim Cook. I had dinner with sort of almost all of them, and the rest are coming. One of the big differences between the first term, everybody was fighting me. In this term, everybody wants to be my friend. I don't know. My personality changed or something. It's a big difference. The big difference is that the first time everybody was fighting me on all fronts.
President-elect Donald Trump in a stem winder of a news conference last week. Everyone wants to be my friend, he says. Indeed, many leaders from high tech have made pilgrimage to Mar-a-Lago to meet with the president-elect. Bill Gates may be next, as Donald Trump writes on Truth Social. Where are you? When are you coming to the center of the universe, Mar-a-Lago? Bill Gates asked to come tonight. We miss you and X. New Year's Eve is going to be amazing. DJT, unclear he even meant to post that on Truth Social, but of course it reminds us of the parade of executives and world leaders who have been trying to get in front of Donald Trump ahead of his inauguration. The transition to the incoming Trump administration has preoccupied all of Washington, and that goes for the diplomatic corps as well, something I discussed recently with a veteran diplomat, a veteran of Washington and of Donald Trump. Dame Karen Pierce, who's been the UK's ambassador to the U.S. for some time, on the transitions as we sat down in the ambassador's residence here in Washington.
I've met President Trump and I know him, and that's certainly extremely helpful. Not all the people will be the same. Some of them we know from the Hill. Sure. I've met Senator Rubio, I've met Congressman Mike Waltz, very fine people. And then we'll just try and make as many new relationships as we can. And what we really want are not just friendly relations, obviously. We want productive ones. We want to get to a stage where you can have deep conversations about the direction of policy, whether that's Treasury, foreign policy, defense, or health.
You mentioned Mike Waltz. You do have a special relationship with him, if I can use that phrase, following your time serving as UK ambassador to Afghanistan. How has that helped to create a bond between the two of you? What are your conversations about?
Well, the first thing we talked about when we first met was Afghanistan. I actually met the congressman's wife first. That's how I knew he'd had this very distinguished service in Afghanistan, Green Beret, extremely impressive. But of course, Congressman Waltz has also worked on the policy side of earlier Republican administrations. And we have lots of stories about different parts of Afghanistan where we've each been. I should explain, I was an ambassador. I wasn't in the military. He's had a much more adventurous time than me.
Well, here we are sitting under the portrait of Winston Churchill on his 150th birthday. Pretty remarkable as we look at the landscape today and go back to that moment when he made the first framing of the Cold War. He talked about the Soviet threat.
From Stettin in the Baltic to Trieste in the Adriatic, an iron curtain has descended across the continent.
He talked about the Iron Curtain moving across Europe. What would he make of this moment in time that we're in now as we see an emboldened Vladimir Putin and the war in Ukraine?
I think he would feel that his instincts on Russia were proved right again. It was striking how, even though during the Second World War he was very ready to work with Stalin and the Russians because we had a common enemy, it was very striking how quickly his thoughts started to turn to the Soviet Union as antagonistic to the West, and he was proved right on that. Whether or not he'd call it another Iron Curtain, I don't know. I think it's something that Putin would like to do, to have more influence in Eastern Europe. You see it in some of the candidates standing in elections in East European countries. Some of them are close to Putin. But you also see other parts of Eastern Europe already in the European Union really want to solidify their relationships within the European Union and within NATO. So I think it is different. I think Churchill would be very pleased to see that NATO had its 75th anniversary.
What would he make of this debate then, particularly in the United States, about what to do with NATO, about whether to support the war in Ukraine, about what role the United States should play in this alliance?
He was a very firm believer in leadership by the United States. He had a rather elegant phrase about the old world giving way to the new, by which he meant the sorts of leadership roles Britain had played in the world in the 19th century would now be assumed by America. And I think he'd be very proud of NATO, which is fundamentally a defensive alliance, a political alliance. I think he'd be very proud of the way NATO has kept going. And I think overall he'd be here in America. He was half American, his mother was American, encouraging American leadership on the global stage.
To what extent, in your experience in the residence, the embassy, and to what extent you will continue to work here, have you been able to employ the tools of the embassy, whether it's the building that we're in, the architecture, the events that you put together here, or the bounties of the kingdom, whether it's a sparkling wine or a whiskey, a single malt that somebody might not have unless they were sitting down with you. This is all part of your job, isn't it?
Yes, it is. It's exactly what diplomats do. Some people are unkind enough to imply that's all diplomats do. But I want to assure your audience that's not the case. We do as much with hard power. The defense, security, intelligence relationship between Britain and the US is vital. Again, Churchill, that same speech you mentioned, was the first time the phrase "the special relationship" was coined.
That's right.
So I just want to point that out. But you're right, soft power. We try to serve British produce at the embassy. We don't always succeed, but we do as much as we can. We have very good sparkling wine now.
Yes, right.
It is one of the very few positive things to emerge from climate change. It has made the south of the United Kingdom extremely prolific and proficient at producing sparkling wine.
What do you make of that? So climate change will make the UK the next major wine destination?
Oh, I don't know if I'd go that far. And there are lots of huge downsides to climate change.
Well,
but one of the things is this wonderful sparkling wine. So we try to serve that. I think all in all, we want the American people to be interested in Britain, and we want young Brits to be interested in America.
You're the first woman to have become the UK's permanent representative to the United Nations, Britain's first female ambassador to the US. That, by definition, makes you a pioneer. In that period of time, how has your business, the world of diplomacy, and Washington changed?
Oh, I've never been called a pioneer before.
Oh, I don't know about that.
I'm a city-loving, indoors person, so I'm very pleased to be called a pioneer. People always think diplomacy changes a lot, and the tools change. So obviously we have social media now, which is very relevant to soft power. Obviously we have iPhones and the internet. Where the internet was only just coming in when I was first here 30 years ago.
But also in that time, when you look up from the table, you see a more diverse room, and you see more women, do you not?
More women, more people of ethnic minority origin in Britain too. I mean, America is a very diverse society, and I think people don't always realize how diverse Britain is. Right. And one of the things we like to do in soft power is think of ways of celebrating and using that diversity to bring different groups of people together.
As we were discussing, this is the bounty of the UK. What do we have here?
This is an English sparkling wine from Kent. It's just won awards. It sells very well over here. We try and serve it whenever we can. Churchill's favourite champagne was Pol Roger, but that was because the English sparkling wine industry wasn't going in Churchill's day.
Got it.
So we're very proud of this and just delighted to be able to toast you and toast America.
What a treat. Happy holidays.
Happy holidays.
And thanks
happy
for having us at the embassy. Cheers.
Very good to see you. Thank you.
Big thanks to Dame Karen Pierce, the UK's ambassador to the US, for a great conversation. That drink gets more appropriate as we get closer to New Year's. Since I sat down with the ambassador, by the way, the Trump transition team has made some news. Donald Trump naming Warren Stevens to be U.S. ambassador to the UK and Mark Burnett as special envoy to the kingdom. Two roles that we'll be following very closely here on Bloomberg. Watching Wall Street in our remaining moment together. Not great today. Stocks selling off. The S&P 500 down 73, a little more than 1% right now. The 10-year yielding 4.61%. Bitcoin lower, off its lows, but still down 1%, trading around $94,000. Higher is the VIX. We're watching volatility rise today, up 14%. To trade just under 17. Crude oil at $70.61 a barrel, WTI. That's where we are. Let's get to the weekend. I'll meet you back here high noon Monday, Washington time, on the fastest show in politics. Bloomberg Markets on the way next. Stay with us right here on Bloomberg TV and radio.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
There is no backwards in recycling. There is no backwards in treating pollutants in the water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services even in time of crisis, as well as to see the long term and deliver good results, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
We're scaling up at incredible pace.
This region is growing so rapidly.
The opportunity is really huge.
Only on Bloomberg. Context changes everything.
Welcome to a special TV and radio edition of Bloomberg Markets this Friday, December 27th. I'm Vonnie Quinn.
And I'm Shonali Bassick. We're here at Bloomberg's world headquarters in New York. And Vonnie, we are looking at a day that is on thin volumes, but lower on the day.
We did try to manifest yesterday, Shonali, but it is a red Friday, I'm afraid. We are off our lows, but if you look at the S&P 500, down 1.2%. The NASDAQ 100, there are just a few elements in there higher. For the most part, they are lower, and that index is down 1.5%. It's even extending to the Russell 2000, which is down 1.75%. And then, of course, much of it is to blame on the SOX index, the Philly SOX Semiconductor Index. Right now, we do have two elements in there that are higher, but just barely. Advanced Micro Devices up by 0.3%, but really all of the rest of the components to that index are lower.
Yeah, if you take a look across assets as well, it's pretty interesting because in addition to seeing the indexes lower, you're seeing volatility higher, which is what you would expect. Of course, as we've been saying, thin volumes, but yes, every index, major index down 1% or more. That has brought volatility up just under a 17 handle, low relative to the highs that we've seen this year, but elevated relative to the last couple of days. We're also looking at crude oil here, hitting that 70 handle once again, up about 1.4%. Also taking a look here at Bitcoin, because we are seeing volatility in Bitcoin this week as well. We're seeing Bitcoin still hover well below that 100,000 level, standing at around 94,326. Also taking a look here at treasuries, because fascinating moves there as well. And while the moves seem muted relative to what you're seeing in the equity market, you are seeing that 10-year back above 460. You're seeing it almost 3 basis points higher at 461 on the day. The 2 years 1 basis point lower at 431. But of course, the longer end of the yields curve here, seeing yields rising, a really interesting way to end the year, Vonnie. And I'm sure that spillover of higher for longer rates also impacting the equity market by now.
And I do want to point out there are some individual movers to the upside, including Lamb Weston, the maker of French fries. They don't just grow on trees, you know, you have to actually make French fries. Lamb Weston is up almost 4%. It's had a wonderful week, more than 10% higher. Jana Partners, of course, disclosing more than 5% equity stake and potentially putting forward a director now for that board of directors. But for the most part, what you're seeing is red on the screen for all of those names that we were dependent on all year for the gains. You have Tesla lower, Nvidia lower, Palantir lower, all the Trump-associated names. Possibly some profit-taking at the year-end.
Possibly some profit-taking, and certainly that Santa Claus rally that we've seen at the earlier part of the week is now over. We are not going to bring in Alex Semenova, of course, of Bloomberg News, follows all things equities for us. It's interesting to see this tech sell-off today, the broader equity market sell-off as well. If you take a look at, for example, what we've seen from Nick Colas over at DataTrack, he says that the levels that we're standing at now for the S&P 500, a 38 times Shiller price-to-earnings ratio, that historically leads to a poor forward 20-year return. But he thinks this time is different, partially because of tech. How convinced are investors, by and large, that this time is different, especially when you're starting to see some real volatility in those tech names also dragging down the broader indexes?
Well, Shonali, you know, it's really true that I think that right now is certainly different from any time in history. Obviously, consistent with that point that Nick Colas makes. We also had Goldman Sachs saying that we're going to see annualized returns of 3% on the S&P 500 index over the next 10 years, because if you're looking at valuations alone, that there's not much more room to run, obviously, with rising yields. But this time is exceptional. It's different because we have the potential of artificial intelligence always also driving stocks higher. I had a conversation with Julian Emanuel over at Evercore ISI. He thinks that the S&P 500 can go to 6,600 by mid next year. He says that, you know, this time is not like any other time. When you look at these companies that are posting outsized profits that are spending on artificial intelligence technology, and we're going to see them monetize on that next year as well. That is supposed to bode well for these companies. And if you go back 2 years, the S&P was trading at 17 times earnings. Everyone thought that was expensive at the time. And here you are 2 years later, and we've gotten more than 60% run in that index, obviously driven by these tech companies that so many people thought a while ago would stop seeing gains, and here they are still continuing.
It seems to be very difficult to be a bear out there on the street. The only price target for the S&P that's lower than where we are at now that I could find was Stifel. Everybody else is higher.
Yeah, Stifel's Barry Bannister is kind of the only contrarian at this point on the street. Everyone, even the naysayers for the last couple of years, are expecting further upside in the index. Notably, JP Morgan had a target of 4,200 on the index for the past 2 years. It stuck with it, even as some of its peers on Wall Street were raising their targets. But I just had a conversation with Dubravko Lekos-Buhas over there, who's their chief market strategist, and he said basically there are 3 puts in place for next year. The China put, obviously we're getting stimulus out of that nation. The Fed put, with Jerome Powell expected to ease monetary policy, and the Trump put with Trump expected to be very pro-market. So those things should drive this risk-on sentiment in equities into 2025, even after these 2 straight years of returns of more than 20%.
It's interesting. Another set of commentary I was taking a look at was Louis Navalier, of course. And one thing he says is today you can't blame it on interest rates, which were largely flat this morning, though clearly elevated for the month. VIX was back up to 18. He notes also that Apple didn't make it to that $4 trillion level. You were watching Apple just a day ago at new record highs. What does it mean? You have more and more investors pointing out kind of the dominance of tech, yet that vulnerability that the index has to big tech. Torsten Slok over at Apollo pointing out that it's almost dangerous for diversification at this point to have that much of your index weighted to a sector and certain companies within that sector.
Right.
So does that yield more volatility ahead? If the Mag 7 isn't performing, then how could you expect your broader index to?
It does. I mean, we're seeing some of the perils of that today. Look at this unwind in big tech. Some of the names that have done so well this year are the ones that will be sold once there is any kind of broader selling pressure. But at the same time, we've seen the index still do well, even as concentration risk has been discussed for the past 2 years, right? Valuations aren't necessarily what end bull markets, and they are a problem when they become a problem, but so far it hasn't really impacted the indexes.
Alex, thank you so much. Alex will be back with us in the next hour. That's Alexandra Semenova, Bloomberg News. For more market analysis now, we're joined by Tom Martin, Senior Portfolio Manager at Global Investments. So Tom, thank you for joining. Shanali mentioned Louis Navalier. He says, though, there's no reason to panic. Earnings season kicks off on January 15th and all will be well. What do you think?
Well, thanks for having me on your program. And it's you shouldn't really read too much into what happens in the month of December in general, and especially the last few days in here, because as you pointed out earlier, the volumes are so light. So you really have to look forward to the next year. And I think what's a little unusual so far at the end of this year is because we've had 2 years of gains, it's hard to find losses in investors' portfolios. And so to the extent that you want to make a change in your portfolio or change your positioning or reduce some of the holdings that have gone up so much, maybe not sell out of them completely, but just sort of reduce your exposure and go elsewhere, you have to sell and take gains. And, by and large, that's not a great thing to do at the end of the year. So we might be in for a little bit of not so much the positive January effect at the start of the year. I mean, who knows how January will end up. But as we look to the end of the year, to 2025, all of the positive fundamentals that you've factored in for tech and then for the broadening of that in other sectors of the market are really hard to argue with. That's why it's hard to find a bear.
I want to point out this note about big tech from Bloomberg Intelligence, because even if you believe tech can keep driving the indexes higher, you still have our analysts finding that nearly 30% earnings growth for this sector is estimated for next year. But right now, it's been trading closer to 40% growth expectations. So you could argue that it's already overvalued. What do you make of that argument?
Well, you could, and you could make that argument for the market as a whole, not just these companies, but just when you look at the value of the market relative to gross domestic income, it's at 2 times gross domestic income. It's at a very high level, and household ownership of stocks is also very near those levels. So again, when you're not finding a bear, you're also finding a lot of ownership of stocks that's at very high levels. And so you have some vulnerability just on that basis alone.
What are you seeing in terms of inflows or outflows? Are we going to see these outflows that we're seeing in December continue, Tom?
Well, it's doubtful, at least over the longer term. We've seen a surge in the 50-day and the highs of the 50 days of flows into ETFs. And so as investors, are experiencing FOMO and want to get in, if you see in the market up 28% on the S&P 500, 38% on the Russell 1000 growth, you'd like to be able to participate in that. So people are hopefully positioning for a little bit longer term than just a short trade, and expecting that they're going to get some rate of return out of the market in 2025.
When we think about the Santa Claus rally and the way that it has faded in the equity market, you also have to watch how that bond market has been moving and the fact that the 10-year yield is above 460 once again. And if you're seeing the bond market sell off in such a manner at the longer end of the curve, at what point do you start to think the market is telling you something here, that you might see not just fewer rate cuts next year, but none?
Well, that's exactly right. I think the key is the 10-year and the yield on that. And, although we have been up closer to 5% in the not too distant past, we've been accustomed to rates being down at 4% and below that. And with inflation expected to be tame and not really worrying so much about the debt level of the U.S. government. But as we've had a change in the administration, they're coming in, there's things that we think are going to happen, but we don't know are going to happen. Inflation has not come down some more, and the Fed has really backed off on their rate path, as has the future expectation. So getting up above that 4.5% level and then kind of moving on towards that 5% level is a little scary. Stocks have held in, and usually it would be a lot worse for longer duration assets. We've had a few of those days. This is one of those days. This is a sell your winners day and a sell long duration, but they haven't lasted long. We've come back to those same old winners in the market.
Tom, how do small caps perform in an environment where you still have the 10-year at 4.6%?
Well, a lot of the issue for small caps is refinancing risk and their exposure to just sort of one product or one market. So they're a lot more exposed to volatility and to something specific going on. And that's why the small caps rally has not sustained itself. And we've seen several attempts earlier this year, but they keep continuing to underperform going back. And I think that you're going to have a substantial reduction in rates that looks a little bit more sustainable before you can get a sustainable rally in the small caps.
Tom, we thank you so much for your time today. Of course, making sense of this year-end sell-off. Tom Martin, Senior Portfolio Manager at Globalt Investments. Now, coming up, the AI stock play of the year. Profitability still remains elusive, though, for some companies that have made strides in the technology. A closer look at the challenges and shifting strategies of AI next. Vani, we're going to talk all about that AI trade, but we're also going to talk about OpenAI.
OpenAI, exactly. That's all coming up next. But I do want to just refer back to what you were saying about Nick Colas and his most recent note today. It's really hard to be a bear out there. He says in the first case, when we saw levels like this with a Shiller PE at 38 for the S&P 500, that was in 1999. And the second case, it was 2000. First time around, the S&P returned 20.9%. Second time around, it was down 9%.
So
how are you supposed to make sense of that?
Exactly, because of course the problem is the downside can be quite large if you have that risk reward off. A lot of investors looking to that broadening trade, at least diversification trades, but those diversification trades have not also paid off in the last couple of years. Bond markets also volatile, hard to find a haven trade. Stick with us. We're going to talk more markets next. This is Bloomberg Markets. This is Bloomberg.
Well, Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Welcome back to our Bloomberg television and radio audiences. This is Bloomberg Markets. I'm Shonali Basak. I'm sitting alongside Bonnie Quinn, and we're going to talk now about AI, because many AI-related companies this year have seen their stocks surge, but the financial returns from AI are not yet understood. Increasingly, AI developers are finding their models are not improving as fast as they used to, and therefore profitability remains elusive. That is the topic of a new piece out from Bloomberg Originals, Why AI is Facing Diminishing Returns. Take a listen.
It broke the internet overnight.
A new artificial intelligence tool is going viral.
It's called ChatGPT.
It can answer follow-up questions. It can admit its own mistakes.
When ChatGPT came out, it really quickly gained traction. You might ask it, write a poem about unicorns, and it might spit out something that sounds just like it was written by someone. That really struck a chord with a lot of people. It also struck a chord with investors.
Tech companies and their investors have sunk billions of dollars into building AI systems with the bet that these tools will keep getting more sophisticated and one day prove wildly profitable.
There's this concept in AI that if you just sort of keep feeding an AI model more and more data and more compute power, that it will start to just sort of teach itself and become smarter and smarter.
But progress seems to be getting a little bit trickier for some of these big companies.
As expenses skyrocket, an industry known for moving fast and breaking stuff could be slowing down.
I think the progress is going to get harder. When I look at 25, the low-hanging fruit is gone.
They're trying to figure out, how do we make these models that are getting increasingly expensive, eating up increasing amounts of computing power, worth that trade-off, right? If you're not getting this incredible boost in performance, what do you do?
ChatGPT and AI systems like it work by using massive software engines called large language models, or LLMs.
A large language model is an AI system that's trained on lots of data sourced from the internet typically, and it can respond to written prompts with other amounts of text that sound really like they were written by a human.
To do this, these models use an algorithm to process the parameters of any given prompt, and this is how that unicorn poem comes into being.
For a while, these models have been getting better quickly, but right now, at least 3 of the top companies, OpenAI, Anthropic, and Google, are having issues training their models to the level where they would like them to be.
as we're spending more and more money, the engineering complexity of getting it right is increasing, and that's why companies need to be larger, need to have more talent.
It's hard to say if anyone's making money off of AI right now. We do know that OpenAI has quite a number of paying business customers, but we don't know how that breaks down in terms of like the exact number of companies that are paying for it or what kind of benefits these companies are actually seeing.
But it's not all about the money, is it? Let's keep in mind, OpenAI, for example, was established as a non-profit research company focused on advancing AI for the benefit of humanity. Of course, it plans on shifting to a for-profit model, but the timeline on that is unclear. And still, despite the wintry forecasts, the money keeps pouring in.
They have plenty of money at the moment, but it's not totally clear if companies are going to be using it long term, what kind of return they're getting on their investment.
Perhaps the most exciting thing for AI enthusiasts, and the most horrifying for its detractors, is the prospect of artificial general intelligence, or AGI. AGI would be a system that can reason and think like a human, applying its synthetic brain across disciplines, not just reacting to prompts with poems or six-fingered hands, but accomplishing complex tasks independent of us humans, and maybe even surpassing us. Could we one day be working for them?
No one exactly agrees on, when we're going to reach AGI or what exactly it will look like. A lot of people are predicting that it can come very quickly, right? You see other people saying it could take decades, it could take a century, it could even never happen. And something like some of these setbacks that we're seeing give people reason to maybe reassess or say, hey, this path to AGI may not be as simple as some wanted.
And you can watch that piece online on the Bloomberg Originals YouTube channel and on the terminal. And let's continue this discussion now, because as we saw in that piece, many AI companies saw their stocks surge, and it was founded, of course, as a research organization, this OpenAI, a decade ago. But now it's considering a restructure that would create a more conventional money-making corporation. For more, we're joined by Shireen Ghaffari with Bloomberg News in San Francisco. So we heard a little bit about this in the piece, and it's potentially what caused the big friction between Sam Altman and OpenAI earlier this year. Shireen, what do we know right now about what the company is considering?
Yeah, so we know that the company's board is considering a shift to turn OpenAI essentially into both a for-profit public benefit corporation entity and then keep a nonprofit arm separately. But what will be different is that the nonprofit would no longer control the for-profit as it does today.
So how is this widely being received? Because, of course, we know that there are a camp of people that believe that, well, wait a minute, this is not why and how it was originally formed. Why would it evolve now, especially in the midst of such potential future riches?
So what the company's board is saying is that the reality is that AI is capital intensive, that the company needs a lot more investment in order to grow, and that its competitors have a less complicated structure. And if OpenAI wants to continue to innovate, that it essentially needs a simplified corporate structure. So that's the argument for it. But of course, this does bring up questions about the original mission of OpenAI and whether it will be able to do so with a more conventional for-profit structure.
So, Shireen, explain to me how you have for-profit and public benefit structures at the same time. I'm not saying that there aren't for-profit companies out there that benefit the public, but how do you intentionally have a public benefit structure with a for-profit? I don't quite understand.
Yeah, so the idea is that the public benefit company is a type of for-profit company. One of OpenAI's biggest competitors, the AI startup Anthropic, has a public benefit corporation structure. There are some other notable examples, but the idea is that it's essentially a for-profit that still has a sort of do-gooder or a mission that is beneficial to society. Now, that's different than a nonprofit, right? And so OpenAI, in addition to that, is saying that it will keep a nonprofit that will pursue charitable interests in areas like science or education, and that nonprofit will own a significant amount of shares in the for-profit entity. So that's how they're essentially trying to thread the needle between fulfilling OpenAI's original promise to benefit society with AI while still being able to essentially raise and make money more simply.
You were speaking about potential future capital needs, this idea that having a for-profit entity might help them in that regard. Do you see this as one day becoming a public company where a much wider array of investors could finally get a piece of the pie here?
I definitely think that's a possibility in the future. When we'll see that, I actually recently interviewed OpenAI CFO. It doesn't seem like that there's any imminent plans to do that right now, but is that going to happen in the future? That's certainly, I think, what some investors would be hoping for when investing so much into a company, that they will essentially see a return on that, right? So time will tell exactly when, but I think this restructure could set them on a path to potentially do that more simply.
Shireen, we thank you so much for your time. You're reporting. That is Shireen Ghaffari of Bloomberg News in San Francisco, talking about the latest on OpenAI. And in addition to that, we should also talk about how AI is increasing the demand for electricity across the country. This has become a huge issue, Vani. A story published earlier today by Bloomberg shows that data centers are multiply across the U.S. connected to AI, and they're sucking up huge amounts of power. There's new evidence that shows that they might be distorting the normal flow of electricity for millions of Americans. The problem is threatening billions in damage to home appliances and aging power equipment, putting a lot of stress on grids, especially in areas like Chicago and in Northern Virginia, a place that's now being nicknamed Data Center Alley.
I love this. The term is bad harmonics, and it's when glitches like this can actually cause your refrigerator's motor to run faster and for your appliances to heat up.
It sounds like a band name. In those spaces, specifically in Chicago, Northern Virginia, you're seeing those distorted power readings, bad harmonics, as you call it, already above recommended levels. So we will keep an eye on that story, but you could find it on the Bloomberg terminal and on Bloomberg.com. We're going to switch gears. We're going to talk more about energy, different type, though. We're going to talk about natural gas supplies on the chopping block. What happens if Ukraine and Russia can't reach a deal to keep the fuel flowing? We'll break that down next. This is Bloomberg.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ये बुरा हो जाएगा.
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Top names in business are on Bloomberg.
The question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are, and that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. We got to realize that the impact we have if we don't get this debt back in line.
Nobody covers business like Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
And welcome back to our Bloomberg television and radio audiences. This is Bloomberg Markets. I'm Shonali Basak alongside Vonnie Quinn. We're going to talk about natural gas right now because Europe is about to lose a major chunk of its gas supplies. A key transit deal between Russia and Ukraine is expiring next week on December 31st. Unless another arrangement can be made in the next 4 days, the halt of Russian flows via Ukraine will put further pressure on what has already been a tight market. For more on this, we're going to go to Bloomberg's Natalia Nijevic. What do you see as playing out in the natural gas markets as far as pricing goes, given the pressure that you're seeing in terms of this Russia-Ukraine deal?
Exactly. So we saw that today European natural gas prices rose by almost 5%. Keep in mind at the same time that the story is a little bit different versus how it looked a couple years ago. Now, those flows via Ukraine account for about 5% of all demand for natural gas in Europe. Earlier, again, a couple years ago, it was about 60%, if I'm not mistaken. So now, nevertheless, we see that it creates a lot of volatility. Europe will have to rely more heavily on other supplies, such as pipeline gas from Norway, such as U.S. LNG flows. And this creates, of course, lots of opportunities for traders to play this game. Because, again, when it comes to natural gas, the story is very different across the world. We see that European natural gas futures are up. But here in the United States, the story is completely different, because here demand is driven by weather, right? And we see that natural gas futures are moving lower. But nevertheless, we see that there's a big divergence right now in terms of how traders play gas stocks versus oil stocks.
Yeah, it's fascinating. So when we got the rig count and also the storage data for natural gas this morning, we had the frontman contract just completely go negative here in the US because it trades on a completely different dynamic to that of Europe. Is there any possibility in 2025 that, you know, anything that goes on in Europe will impact US natural gas supplies?
There are so many factors, and the story is now so complicated when it comes to natural gas, right? So on the one hand, there is demand from Europe. Here in the US, there are some other factors, and some traders I spoke with, they are saying that natural gas can become the next AI play, because now there is more demand from data centers for power, right, for traditional utilities. But at the same time, demand is so high that traditional utilities, some of them will probably won't be able to meet that demand. And that is where natural gas producers, suppliers, and gas-fired power supply can come to a play. So more demand, again, domestically and internationally. And what we see in the stock market, it's been a really interesting year, because for the first time in many years, natural gas stocks outperform oil giants. For example, if you look at the stocks like EQT, it outperforms oil giant ExxonMobil. And that is why we see this is also driven by fundamental factors. Demand for natural gas, at the same time, oil is so volatile. We see that crude is down by almost 7% year to date. And this is mainly driven by concerns in China, right? Demand is really low. The market is facing oversupply. IEA saying that the market will potentially see more than 1 million barrels a day of oversupply next year. We see that OPEC is very cautious. They reduce forecasts for global oil demand. So that is why we see that traders are moving from oil stocks to natural gas stocks. It's a really interesting play right right now.
It's a really interesting play, especially because energy, by and large, as a sector, has not performed as you would think it would. It was something where you thought drill, baby, drill would be the big trade going into the Trump administration. That's not seeming to play out as initially planned, is it?
Exactly. So earlier today, 2024, right? So we saw a big spike in oil prices. We saw even bears like Mike Wilson. He upgraded at one point energy stocks to buy. That was during the first half of this year. It was a big play. We saw hedge funds played actually this trade really well. Then we saw more concerns about Chinese demand. It all comes down to China because China imports so much oil. We saw oil prices moved down really sharply. As a result, energy stocks followed those fundamental drivers, and that is why we see that, again, the slowdown closer to the year end, and that is why energy stocks are not doing well. But probably 2025, we will see a completely different story.
Vani, it's the second worst performer in the S&P 500. When you look at the sectors, it's barely up on the year. Out of the top 20 stocks tracked by the S&P Energy Index, only 9 are up. And so you've seen a lot of divergence there, particularly ones involved in M&A, but by and large, the sector has not done well this year.
And I do think when you talk about the Trump trade, we kind of need him to be inaugurated before we know exactly how that's going to play out, right? And see who he actually gets confirmed and what kind of policies they all start to put into play. Our thanks, though, to Bloomberg's Natalia Kniziewicz for joining us. She'll be back with us again a little bit later on. And this story, of course, highlighting the need for increased investment in renewable and sustainable energy resources. So joining us to discuss more on this is Tony Perrotta, who is sustainability and regenerative economy expert at PA Consulting. So, Tony, what are you expecting from the next Trump administration, given what we saw the last time, given the drill, baby, drill type rhetoric that we've been hearing, and given the mandates already in place?
There's a lot of speculation about what will happen on January the 20th and what's ahead of us. Most of that speculation seems to point to a rolling back of environmental policies, but there could be positive aspects as well. First, a number of technologies have already passed the tipping point, like wind and solar, and in a growing number of cases, nuclear, and those will continue to thrive. We also know the real implications of plastic waste as an example as well. This won't change in the next 100 days. Second, don't forget that these challenges represent huge opportunities for the entrepreneurs and organizations that solve them conveniently and profitably. Reduced regulatory pressure should mean more innovation and investment in the private sector. This will be led by clean technologies as businesses capitalize on that. And the financial cost of climate change has been staggering in 2024. Swiss Re estimates that it's a cost of $310 billion alone in 2024. Those who help solve these problems will be clear market winners.
So one area that you had mentioned there, I want to drill in on just for a moment here. It's because you just saw such a, let's call it significant sell-off when it came to solar right after Trump had won the election. What kind of evidence do you have that solar can continue to be a profitable and significant investment area as you move forward? You said it was reaching a tipping point. Can it live on its own without a bigger set of support systems from the government?
Well, innovation is always going to be absolutely critical to any new and advancing technology, especially as we move to scale up. What we will see is material science as a theme overall. That includes biomaterials, but it also includes material science related to solar, wind, and nuclear, continuing to innovate. So again, those are market opportunities. Entrepreneurs are at the ready, looking at how might the intersection of science, engineering, and design help bring that opportunity to life and push this market forward. In addition to that, more and more companies are realizing we have a never-ending thirst for energy. Fossil fuel alone will not be able to support that. We will be mandated and pushed into alternative types of energy as well.
What about recycling, Tony? Because as much as, over the past, say, 20 years, I've seen a huge effort in America to start to recycle, it feels very far behind. Where are we in recycling?
I think all of us would say we wish we were further along. 2024 has seen a lot of changes happen, none of which we would like to see repeated. The issue posed by plastics and recycling is a complex one and will require a number of solutions. We can offer 3 key areas that we think will be critical to solving this issue. First, the world has to lean into enhanced mechanical recycling practices, leveraged by vision technology, of course AI, and definitely supported by robotics. You've got companies like Waste Management, in particular, leaning into AI and Republic Services, leveraging robotics. Second, advanced recycling methods are definitely coming onto the scene in a much bigger way. Here in the US, you've got companies like Eastman Kodak and PureCycle leading that charge. And then finally, what we're most excited about at PA is a move away from plastics into alternative materials altogether. That includes things like seaweeds and alginates and plant-based fibers. We tend to be very excited about a move into fiber itself. We see what we would call a paperization, if you will, of entire industries coming.
So when you think about the paperization, ultimately, how does this get done at scale? Because it sounds like a great idea to use seaweed instead, but can you see that being done at a rate that can really start to replace a lot of the more traditional systems that we're seeing?
It's absolutely scaling. So those of us who managed to avoid being on the naughty list this year likely noticed a lot more paper packaging, replacing what typically would have been a plastic tray or a plastic insert, especially in consumer electronics. That's being led by 2 things. A, it's getting much harder for companies to access recycled plastic material. That cost is going up, and access alone is difficult. B, they are realizing consumers really are looking to move away from those materials, especially when they're not necessary or essential. The industry as a whole is seeing a huge surge in a transition away from what would typically be described as a petroleum-based material to paper alternatives. We're already experimenting to identify where paper can effectively replace those materials. Again, huge innovation happening in the world of fiber, so plant-based fiber, tree-based fiber, agricultural waste. One that we've seen at PA that we're excited about is something called dry molded fiber. We are seeing these technologies scale. There's absolutely a push by consumers and a pull by corporations to look into those alternatives.
Tony, in the run to 2025 and even beyond that, who's more important, the United Nations in this sphere or simply a Trump administration?
Great question. I would suggest that we still operate in a global marketplace. Of course, the Trump administration and the U.S. will be a significant component of that, but the global marketplace will definitely continue to drive directives. In Europe and in January as a whole, we'll see obviously the new administration take hold, but we will also see the World Economic Forum happening as well mid to late January. In addition to that, Europe continues to innovate on the regulation side ahead of the U.S. in particular. They'll be launching a plastic waste directive in late January 2025, rolling out for the next 18 months. So I wish I could sit here and tell you that the U.S. is leaning on the regulatory charge. We're not at a national level, but you see some states beginning to take on that responsibility. But again, we all operate, especially global companies, on a scale that size.
Speaking of the state level, I want to recognize also that Governor Hochul in New York just signed into law a way to penalize companies for greenhouse gas emissions, the Climate Change Superfund Act. At the state level, do you think you're going to see more progress? And do you think that there's going to be a massive bifurcation forming, especially because of the rollback of some of these ESG measures expected under the next administration?
So I think it'll be akin to most of the innovation that we see happen in multiple industries. You'll see a handful of states be the early adopters and the early leaders. And then once those prove successful, in the other states who have contingents that believe those are favorable, you'll begin to see early adopters and mass adoption. Obviously, as the states continue to gain power in that regard, they'll need to make their own decisions. What I see typically happening is carbon footprint, to your point, greenhouse gas emissions in particular, will likely emerge as the definitive measure of sustainability efforts. And on top of that, the issue of waste and plastic waste in particular is so face forward that will need to be addressed as well.
Tony, we thank you for your time. That is Tony Parada. He's sustainability and regenerative economy expert at PA Consulting. Of course, a very tense time in the world of ESG, Vani. But we're going to switch back to to the broader markets because, of course, we're looking at a sell-off on our hands here. That Santa Claus rally has faded. The S&P 500 below that 6,000 level. And we are going to be speaking next to Michael Reynolds. He's the Vice President of Investment Strategy at Glenmead. He's going to bring us his market outlook for 2025. Stick with us for that conversation next. This is Bloomberg.
There is no backwards in recycling. There is no backwards in treating pollutants in the water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services even in time of crisis, as well as to see the long term and deliver good result, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back to our Bloomberg TV and radio audiences. This is Bloomberg Markets, and I'm Shonali Bassick, standing alongside Vani Quinn. And we're going to talk about retail because after holiday shopping and gift giving comes post-holiday shopping and sales. So even as the holiday season comes to an end, retailers are still competing for consumers. Earlier this week, we talked to Michelle Bacharach, the CEO of FindMine, a company that's helping retail brands target consumers using AI.
So what FindMine does is our AI trains uniquely on what the brand's editorial point of view is, so we can deeply understand how that brand wants to elevate your sense of style, and then we can do that at scale by showing for every single individual product exactly how to wear it, and not just how to wear it, but how to wear it in all the different cores and trends and things that are happening on TikTok and very of the moment.
Well, so some of your brands include Gap, Athleta, Old Navy, the parts of Gap, PacSun, Grayson, Men's Warehouse, and so on. So you have a lot of retailers out there. Are you saying that you take their vision and have it style itself, or are you adding things to it, or are you putting together customers' personal information with the brand style?
It's a mix of all of the above, honestly, and I feel like that's really the holy grail. Personalization was such a big topic in retail for a long time, and retail technology went really hard and deep on personalization. But what ends up happening is that if you just follow the pattern of what the customer buys, they never really get better. They never become more stylish. We all stay stuck in our rut. Whereas what the brand has is this sort of unique aspirational view for how stylish you could be, right? And that actually helps you become a better customer for them, too, because you come back and buy more frequently. So with FindMine, what we're doing is we are personalizing to the end consumer, but we're helping the brand's editorial vision for how you can be a more stylish person come through so that you end up coming back and buying more frequently. In fact, we increase 8% the repeat purchase rate of customers coming back to these sites, which in retail, most customers visit a website once and never come back, and you might not even be profitable on the first visit. So it has a really big impact on the bottom line of these brands.
When you're talking to brands, how do they kind of navigate some of these forces? For example, you were talking about how do you know me so well. For me, I'm a total sucker for Instagram shopping. And I don't mind being told so much about what I might like. Usually I do.
Yeah, well, that's what I'm saying. They're getting it right.
They're finding you one way or another. And so if you think about, how they navigate this social media atmosphere too, and the way people are buying maybe differently than, I grew up in Paramus, New Jersey. It's kind of like the main country of malls here in the United States, the main city of malls. But, I can't remember the last time I went there. So how do you navigate the different ways people are buying online?
People clamor to online in the industry because they were like, wow, what an inexpensive way relatively to having all this real estate. But actually what people are finding is that online is very expensive to operate, not just from a cost of, hosting and infrastructure and engineering resources and all the things that go into it, but customer acquisition cost is crazy high. Facebook and Google, or Meta and Google, are getting insane amounts of money from these brands and retailers to acquire those customers. And so one of the things that we're helping these brands to do is CAC bust, to avoid having to pay a paid advertisement by getting in on the organic conversations that are happening on social, by being on trend and sort of the moment, so that we can capture your attention, we can target you, it's meaningful, and you don't mind, getting targeted that way. You're getting something that's helpful for you. But at the same time, not losing all this money to Facebook and not losing all this money to Google, because you're just part of the organic conversation that people want to be having on these social channels.
And that was Michelle Bacharach, CEO of Find Mine, speaking to us earlier this week. Now, if you got a gift you didn't want this week, you might want to return it, and you wouldn't be alone. Around 40% of consumers typically return one or more gifts. Well, what does it mean for retailers as consumers join the post-holiday rush to get their money back? B-Stock CEO Marcus Chen joins us now to break down what holiday returns mean for retailers' bottom lines and the measures stores are taking to protect themselves. Marcus, so we've had the busy retail season. Does it mean now that for somebody like you, for B-Stock, we're going into your busy season, because it's in the next few weeks that people are going to start returning some of those gifts?
Yeah, that's exactly how it works in our world. We obviously see all of the rush with all the purchasing that happens before the holidays, and now people are probably starting to think about returning some of those things, and that's where it starts to get really busy on the return side of things.
So how does it exactly work? Explain to us. Retailers call you up and say we have a bunch of inventory that we are not putting back on our shelves?
Yeah, so a lot of the partners that B-Stock works with from a retailer perspective have kind of the operational discipline to figure out how to manage this excess inventory. So things that come back from you and me, whether it's the sweater that didn't work, the size that didn't fit, that inventory comes back to them from a facility perspective, and they basically list it on what we create a stock market basically for this type of inventory. So business buyers can buy this inventory in bulk and then resell it themselves to their consumers.
What is the resale price relative to the prices that you would have the first time around?
It obviously really depends on a whole host of things. So, for example, consumer electronics, for example, is a category that sells really well from a pricing perspective relative to the original retail price, whereas maybe fast fashion or apparel and some things like that tends to be a little bit lower price kind of relative to the retail cost.
When you think about the types of items that are being returned, what are the most returned items that you see right after the holiday season?
Yeah, well, I think probably the most commonly returned thing is anything you get from your mother. But for the most part, what we see a lot of is apparel, right? So obviously apparel, whether it's the wrong size, the wrong color, the wrong style, that tends to happen a fair amount. And so we definitely see apparel, and then toys at this time of year is obviously a big one too.
And I saw tools on that list as well. I thought that was fascinating, especially kitchen items. You would have thought if someone got something like that they would want to keep it, that they're that kind of person. They love their tools and their specialty items. Or maybe I'm just giving away too much about myself. But how do retailers work it out? Because they are out money if they have to give a refund, and yet they haven't sold the inventory on at that point. Do they work out a deal with you on financing? How does the financing of it all work?
Yeah, so from their perspective, it's obviously critical for them to make sure that they maximize the amount of money they get for this inventory. We work with them, again, the market is relatively efficient, so we will help them get like a fair market price and trade it in the market. And again, for them, they're obviously trying to get kind of everything they can get on that dollar that they're selling stuff for.
This idea that 40% of people typically return one or more of their gifts, what does this mean for inventory levels for a lot of your clients? Do they find that they start the year with just too much on hand?
Well, there's definitely, I think that with more and more of these retailers and brands, they are increasingly trying to get more consumer friendly from a business perspective, right? Like loyalty from a consumer perspective is so critical to their business. And so, whether it's kind of keeping the broadest selection of inventory in their stores, whether it's obviously the consumer friendly return policies, e-commerce and online shopping, like they're trying to make it as convenient as possible. And so there is definitely some of that where inventory levels have to kind of be slightly higher, and I think it's a natural byproduct of them growing their businesses.
Do you sell internationally? Who are the biggest buyers for your inventory?
Yeah, so as you can imagine, there's a tremendous amount of demand for inventory overseas, right? Particularly American brands, Western brands, consumer electronics, all of that stuff has a tremendous amount of market outside of the United States where it's just not as easy to get access to this inventory. And so we do see a great deal of our product go to Asia, Middle East, parts of Central Europe, even kind of developing countries in South America and Africa.
We have less than a minute left here, Marcus, but one thing I'm curious about is I've been shopping online more. I tend to buy the wrong size more because of it. And so do you find that online shopping has made that return game that much stronger? More people are returning, and how much more now that people are shopping online more?
Yeah, certainly, the magic of being able to buy things on your phone or your computer without even seeing the goods firsthand has certainly made it so that return rates have gone up, particularly as more and more of us get more we're just so accustomed to kind of buying things online. And so we are seeing return rates go up a little bit. But again, I guess we think about it in terms of what's best for the end consumer, right? And if it's so easy for the consumers to do this, it's actually helping these businesses grow.
Marcus, we've got to leave it there. That is Marcus Shen. He is the CEO of B-Stock. Of course, a lot of people looking to return some items after this holiday season. Up next, we're going to talk about these markets because, of course, we have been down on all the major indices. Santa Claus rally has faded. Light volumes, but volatility a little higher. Michael Reynolds of Glenmead's going to join us next. Stick with us. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jomana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories newsmakers, and insights shaping the decisions of traders across this exciting region.
We're scaling up at incredible pace.
This region is growing so rapidly.
The opportunity is really huge.
Only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ही बुरा हो जाएगा.
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Welcome back to our special edition of Bloomberg Markets. To our TV and radio audiences, I'm Vonnie Quinn along with Shonali Basak. And Shonali, it would have been nice to finish in the green this week, this almost final week of the year, but I'm afraid we're not going to do it. It looks like with an hour left in trading, those indices are going to stay in the red as they have been all day, with the S&P 500 down 1%, the NASDAQ 100 down 1.33%, well off their lows, I should say. It has been worse today. The Russell 2000 down 1.4%, and perhaps the worst performer of all, the Philadelphia Semiconductor Index, it is down 0.8%, but there are just three components higher now, and just one of them with any kind of a gain at all. That's Advanced Micro Devices up 0.8%. All of the other elements are lower.
And with the indexes whipsawing, of course, a bit here, Vonnie, you are seeing, if we flip up the board here, the volatility index, the VIX, elevated just a bit. You're looking at it was higher, was closer to 18 this morning, now at a 16 handle. We're looking at crude as well, up 1.1%, off the lows of September, but nowhere near the highs of this year, but standing at that 70 handle. Bitcoin down 1.2% today, well off that $100,000 mark we had been keeping an eye on. We were flying past that just even earlier in the month, I believe. Now down to 94,500 roughly. Flip up the board once more. Look at treasuries, because that's where you're seeing a sell-off as well at the longer end of the curve. You're seeing the 2-year shorter end of the curve roughly flat on the day at 432. But once you get to the 10-year, this is where I'm feeling a little stunned, because we were at 458 earlier in the week. We are now at 462. We have been watching this bond market sell-off kind of build a little bit throughout the day. Now about 4 basis points higher on the 10-year yield, even more so on the 30-year. Looking at it at 481, more than 4 basis points higher, Vonnie.
Incredible to see where we are as we end out the year. As for individual stock movers, Lamb Weston is up 3.33%. It's about one of the only good news stories today, and it depends on whether you're a buyer or a seller, I guess. But the activist Jana Partners may have a director for that board, and that stock has seen a more than 10% increase just this week alone, having been a bit beleaguered this year. But some of the stocks that weren't beleaguered this year are beleaguered today. So we're looking at Nvidia down more than 2%, Tesla down 5% right now, and of course SMCI, which has had a very, very turbulent year, trading down 3.8% at 32.47 a share. Plenty of stories out there though, so we will dive into some more of them throughout the show.
Yeah, we are, and for now we are going to bring in Alex Semenova of Bloomberg News, watches all the equities for us. There's some more movers you're looking at.
Yeah, as you guys mentioned,
mentioned, really hard to find anything that is trading higher today in the sea of red across U.S. equity markets. But a name that I'm watching is Arena Group. Shares are up about 1.4% right now, though they did significantly pair a much bigger gain earlier in the session, up as much as 17% earlier into trading. This is after the company was notified by the New York Stock Exchange that its plan to regain compliance with listing standards was accepted. This doesn't actually impact the stock much, but if it didn't comply, that could result in a delisting. That's what led to the move higher in shares earlier. At the same time, though, there was also news yesterday that the fitness website Men's Fitness is making a comeback. They relaunched under the Arena Group. The stock was also up 12% yesterday, so a lot of news in that little company.
I missed that one.
Yeah, I did as well. Interesting.
Should have been a hothead.
I know.
This is also the owner of The Street and Men's Journal, by the way, this company.
CEO, formerly worked at Bloomberg. Fun fact.
Yes.
Also looking at Progeny over here, it's interesting. You're seeing another gainer over here for a stock that was already down around 54% this year.
Indeed, and a nice move today, a little under 16%. This is a fertility benefits management company. This move higher comes after Executive Chairman David Schlanger made a sizable purchase of shares in this company, according to a filing. And as we know, whenever a CEO is any kind of executive is purchasing a stock, that's a testament to confidence in the outlook for its financials for the company's future. Schlanger bought about 150,000 shares worth $2.2 million, though Progeny shares are still down 60% this year through Thursday's close.
Wow. Alex, talk to us a little bit about the Mag 7, because of course they're some of the worst performers today. What is the street saying about this? Just some profit taking?
Indeed, Vani. So obviously, the high flyers, the winners that have been leading this market higher, whenever there's any kind of momentum trade like the one we've seen this year, they're the ones that kind of get the worst of the sell-off. As Shonali had been talking about earlier, obviously the move in treasury yields also pressuring the sector. The 10-year up about 100 basis points in September as investors recalibrate their expectations around interest rates. We're expecting higher for longer. So these growth names, these technology companies, there's a little bit more uncertainty about their outlook, but also what's worrying investors is the profit outlook. This group obviously has been driving the market higher because of their outsized profit engine. They've been delivering on earnings, on these AI promises, but that is expected to slow next year to 18% for the so-called Magnificent Seven compared to 34% earnings growth this year. Obviously, it comes down to these challenging year-over-year comparisons, and technically 18% year-over-year earnings growth
is good, right? Yeah.
But when you're comparing, to past performance and you look at the expectations for next year, that's actually lower than what healthcare is expected to post, and not too much higher than materials and other sectors. So not that good for a group that has spent so much money on artificial intelligence.
Well, what's incredible to me is that even if you expected it to earn more next year, Bloomberg Intelligence expects 30% growth. Mm-hmm. It's trading, as we've been talking about, at 40%. So today you're looking at a market that's trading already above expectations, at least for those big tech names.
Right.
And as we know, this market can be unforgiving, so those earnings better come in pretty stellar next year, or we could be in for some hard landings. Alex, thank you so much. That is Alexandra Semenova. She'll rejoin us again later, but for more market analysis now, we're joined by Michael Reynolds, Vice President of Investment Strategy at Glen Mead, which manages almost $50 billion in assets. So, Michael, do we get 18% earnings growth? Do we get more than that? And what will this market need?
Yeah, thanks for having me on. Looking ahead to next year, we're going to be cooling off some of the larger growth numbers that we saw this year, particularly driven by the Mag 7 on an earnings basis from our estimations. The star of 2025 is actually shaping up to be small caps, which are expected to well outpace the earnings growth of their larger counterparts after a pretty tough 2024. It is admittedly after a low base, but I think investors are sort of proactively asking these questions of, okay, we know we've gotten this strong result out of the Mag 7, but how do we improve from there? What's the next sort of comp that we have to beat? And those comps are getting increasingly difficult to beat, whereas on the small cap side, you have the earnings tailwind. You actually have more fair valuations as well. So it's this sort of dual tailwind that may be setting up investors for better results in 2025.
So you are expecting the bull market to continue, but would you want to rebalance, particularly in the equities part of your portfolio here?
we've been actively recommending rebalancing to our clients, especially heading into the year end. And I think part of the market action we've seen today is that rebalancing effect. You know, and maybe it's not too late for a Christmas analogy here, but you know, you get presents and sometimes those presents aren't exactly what you wanted, you return them. I think investors are looking at this very generous gift in terms of Mag 7 performance over the last 2 years and starting to think about giving that back and looking critically at their portfolios as to where the value may lie going forward. So part of that rotation is what we're seeing here. It's always important to get rebalancing in the books ahead of the year end because you want to get ahead of what we've been seeing today. But that's certainly what we've been recommending to our clients.
Right, certainly a small herd forming there. But if you think about that rotation that you're talking about, and if you believe that small caps are a part of it, how do you play that? Is it through the Russell 2000 or the S&P 600 or in more idiosyncratic ways, name by name?
We think there's a lot of value to active management in small caps. Particularly, you can avoid some of the lottery ticket stocks that just don't have a great Sharpe ratio over the long term. Think of your biotechnology stocks where you're perhaps betting on some sort of breakthrough and it's very binary. It either happens or it doesn't. Whereas if you use strategies that have more profitability screens, whether that's through index-based strategies like IJR, where you get that profitability screen to get into the index, or even just more active management on top of that, there's plenty of opportunity to be found in small cap. And we think it's the pond to be fishing in going forward.
But even if you believe that is true, then how do you justify it with a 10-year still at 4.6% and edging higher?
Well, we're looking ahead to the new administration, and we're sort of ticking off a lot of priorities that actually may be beneficial for small caps. Small caps have higher effective tax rates, corporate tax rates, than their larger counterparts. So if we start to see some more deductions like R&D, CapEx coming back into the fold, that can be a tailwind for small caps. And less of small cap supply chains are actually dependent on foreign countries' imports than their larger counterparts. So they may be even less sensitive to tariffs as well. So, you know, you put through all these tailwinds from the new administration as well as earnings tailwinds and fair valuations. It just seems to be all stars are aligning for small caps heading into the new year.
Michael, you talk about some of, say, for example, the biotech stocks being binary plays, right? They either work out or they don't. That's a lottery play. At this point, is AI also that way?
Well, we've certainly seen a lot of these sort of AI-adjacent parts of the market where perhaps they're delivering the hardware or the electricity doing very well. And I think the next step of the AI wave is we need to see that actually deliver results from the AI technology itself, not just the companies that are helping to build the AI technology. You know, there are some pretty lofty expectations built into valuations in a lot of these AI companies. It's a really high hurdle to hit. We look to the tech bubble of the late 90s, where last time we had some of these really lofty expectations, and we don't think we're at those extremes yet, but we're getting in the neighborhood. So investors have to really critically look when they're picking individual stocks as to whether or not those expectations are within the realm of possibility, or if they're just getting overly exuberant.
Speaking of exuberance, you look at some of the targets for the S&P 500 next year, and they are significant. We have barely broken 6,000. We broke it earlier this year. We are not at that level today anymore. There are a series of analysts, including Ed Yardeni over at Yardeni Research, who see the S&P surpassing 7,000 next year. What do you think?
So we're not really in the business of hitting explicit targets or putting out explicit targets for the S&P 500. But what I will say is we're, call it 2 years into this bull market. Now, history tells us time itself is not the enemy of a bull market, but we're sort of looking at this through multidimensional lens where, okay, we know we sit in a late-stage economic expansion. We know that equities are at premium valuations. We've asked ourselves, 2 years into a bull market, if you have those two conditions, how much longer has the bull market lasted? And typically, you actually see it last anywhere between another 2 to 3 years on average. So, you know, we're heading into the new year. Unless we sort of get some big surprise on the economic side, we do expect to see continued gains in equity markets. But late-stage expansion, that usually means more volatility. Investors, from our perspective, should be cautiously optimistic heading into the new year.
What about fixed income, Michael? Obviously, corporate spreads are very tight, particularly high-yield spreads. Any opportunities there?
We think most of the opportunities lie particularly on the long end right now, as we've been seeing interest rates been going higher, especially on the 10-year heading into year-end. We're looking very cautiously at corporate credit right now, where we're seeing spreads, in some cases, rivaling their all-time lows. And we're arguing to investors that instead of sort of picking up those nickels in front of the steamroller, it perhaps makes sense to be taking bets elsewhere in the portfolio with your risk budget.
Michael, we thank you so much for your time today. Happy holidays. Happy New Year to you. That is Michael Reynolds, Vice President of Investment Strategy at Glenmead. Now, coming up, we're going to talk about how businesses across the globe are bracing for those Trump tariffs. Of course, he has promised them, Vani, through the campaign trail, a lot of uncertainty as to how that will play out. You've seen him already put some threats out there when it comes to Canada and Mexico. China is the big question mark. Inventory stocking is another big question mark among companies. And of course, how this might change things more permanently in terms of global supply chains.
And whether when he says it's a jumping off point, it does actually yield something for the president-elect. You know, he's not going to stop until he does get something. And you know, what other ripple effects could we see if indeed he does drive such a hard bargain with some of these countries?
Right, I'm fascinated. For one example, what's happening in Canada. You're seeing an entire shuffling of the political system after you saw the finance minister step down in the face of this. And of course, you're seeing Justin Trudeau really try to navigate his own tenure. A lot going on. We're going to keep an eye on it. Stick with us. We have more markets up next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
And welcome back to our Bloomberg television and radio audiences. I'm Shonali Basak alongside Vani Quinn. This is Bloomberg Markets, and we are going to talk about how the market might be impacted by the president-elect. Trump had proposed tariffs on foreign goods, including a 60% tariff on Chinese goods that could take effect as soon as his first day in office. Minneapolis Fed President Neil Kashkari spoke exclusively to Bloomberg's Haslinda Amin about the potential impact of those tariffs and the U.S.-China relationship.
You know, there's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in. From our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what did policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path? Reinflating, so to speak, their housing bubble doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to, but I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit, and countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
Minneapolis Fed President Neil Kashkari speaking there with our own Haslinda Amen. Well, Trump's tariff threat has the potential to upend the whole global supply chain, leaving both countries and companies to prepare for a whole host of possible disruptions. John Gilson breaks down the measures businesses across the globe are taking in anticipation of the Trump administration for Bloomberg's The Big Take today, and he joins us now. So, John, where is the biggest disruption most likely?
Well, definitely China is in the target zone for Trump. But what is also not to be ignored is the fact that Trump has also threatened Mexico and Canada, our other two biggest trading partners, with increased tariffs if they don't do enough to stop the inflow of fentanyl or illegal immigrants or whatever other threats he sees to the U.S.
The other thing about this Big Take story, and by the way, you can find it on Bloomberg.com and on the Bloomberg terminal. It's a really great one. There's such a wide range of products that you discuss. That is everything from outdoor furniture made in China to European wines being imported at a faster rate to the United States to avoid some of the tariff pressures that they could see. Where are you seeing some of the biggest potential knock-on effects here in terms of goods that might be impacted?
Well, goods is all over the place, consumer goods, and then, pieces that are supplied to U.S. manufacturers. But definitely European wines are going to be more expensive. At least they're worried about it. And the company that we spoke to in Germany, they're saying, we'll just sell our wine to Scandinavia if the Americans, charge too much and we can't compete there. Patio furniture coming out of China, they're shipping it in advance. They expanded their factories in China, and now they're concerned, who's going to buy our patio furniture? There are importers who are saying we got to watch out how much we're importing. For example, there's earbud manufacturer called J Labs here in California. And they're we want to beat the tariffs because their stuff is made in Asia, but at the same time, they don't want to get too much inventory because the technology is rapidly changing. They don't want to be stuck with old stuff that they can't sell even at even though they got it at a lower price. So everybody's trying to figure out ahead of time what to do.
Yeah, it's so confusing. And also, who is going to decide what exactly the tariff is on a particular item if it crosses borders a few times, John?
That gets really, really complicated. A lot of companies moved manufacturing from China to Southeast Asia or to Mexico as an attempt to evade U.S. sanctions, U.S. tariffs and duties. But now the U.S. is talking about, we'll look at the content and see how much of it is, made in China. And there are so many unknowns right now because basically Trump has, expressed a lot of ideas and he's not president yet. And whatever, he does, there will likely be litigation. The World, Trade Organization might have a weigh-in, and Mexico and Canada are also, kind of concerned and might want to weigh in. We saw after Trump was elected, Justin Trudeau went down to Florida as one of his first, meetings for Trump because he wanted to be able to get on good terms with Trump.
It's interesting because what this would lead to is you were saying if you're kind of front-running any potential tariffs that could be escalated into next year and you're shipping goods faster earlier, you're seeing elevated activity at the ports. It feels like just yesterday we saw, dock workers striking. You're seeing a lot of issues around the ports in recent years in terms of labor. What does this mean moving forward, especially with the threat of potentially another strike into inauguration?
Well, exactly, yeah. The East Coast and Gulf port workers delayed their strike until, I think it's January 15th or 16th, so they could be back out on the picket lines in a couple of weeks. And that explains part of why there's been so much throughput to West Coast ports, because people want to get ahead of that potential, work stoppage. We've also seen a lot of air freight increase. So people, they're in a freak out mode, as one of the people we quoted. They don't exactly know what to do. They don't want to spend a bunch of money and then see it not be beneficial. They also don't want to get caught off guard. So everybody's trying to figure out and game plan this ahead. One advantage people have is they saw something similar happen, when Trump was president before and he started putting tariffs on. And so at least they got that playbook to go back to.
Yeah, but there could be downsides to that too, John. So we know that at least the U.S. consumer isn't in a terribly bad shape, right? They might be trading down. There might be, problems among the lower tiers of consumers, but for the most part, they're holding up. What is the danger that in anticipation of potential tariffs, and nobody knows what they will be or if they'll even take hold, that the consumer sees higher prices anyway because the manufacturers and the supply chain companies are trying to get ahead of any potential increase?
That could be an issue that we just don't know yet. How much costs, vendors are going to pass on to consumers. Already, people are very unhappy with inflation, so they have to be very mindful of that. When Trump was president before, inflation was not an issue, but after the pandemic, inflation was front of mind issue for consumers out there. So I don't know how much lawn furniture they'll be selling if it costs a lot more. I know personally, I'm not going out to restaurants as much because going out dining is really expensive too. So there's all kinds of unforeseen, effects that can happen if prices go up, and that's a high likelihood if you raise tariffs and duties on imports.
John, we thank you so much for your time today, and of course, all of your reporting. Remember, this story also cites that, according to an Oxford economics survey, respondents said a global trade war is a very significant risk to the global economy. So a lot of investors out there are really keeping an eye on how things escalate from here. Don't miss the big take, of course, on Bloomberg.com and on your Bloomberg terminal. But before that, more markets ahead. We're going to check in with Bloomberg's Jess Menton in the next block to see what stocks she's watching as the trading day comes to a close. We're just over a half an hour away. Stick with us. This is Bloomberg.
There is no backwards in recycling. There is no backwards in treating pollutants in your water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services, even in time of crisis, as well as to see the long term and deliver good result, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
names in business are on Bloomberg.
The question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are, and that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. We got to realize that the impact we have if we don't get this debt back in line.
Nobody covers business like Bloomberg. Context changes everything.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
You're watching a special TV and radio edition of Bloomberg Markets. I'm Bonnie Quinn along with Shonali Basak, and there is just more than 30 minutes left in this Friday, final trading day. It's the final Friday of the year, that much we can say at least, and we are in the red. We're not going to continue the Santa Claus rally, at least until maybe next week. So as I was saying, just about 30 minutes left in the trading day, and Bloomberg's Jess Menton joins us now to get a look at some of the stocks that are moving underneath the hood.
And that's right. And looking at where we are week to date, the S&P 500 still up about 0.5%, the NASDAQ 100 up about 0.6%. So that would put the S&P 500 on track to snap a 2-week losing streak. And the NASDAQ 100 would be up 5 of the past 6 weeks. So when you are looking at some of those individual movers, I like to use the MOV function to see kind of what's moving in the biggest movers for today. Lamb Weston, LW, is actually the ticker symbol on this, and it's actually up almost 3%. So the best performer so far in the S&P 500, even though we are seeing obviously the index down more than 1%. But of course, when you're looking at this, JANA Partners actually tapped Jeffrey DeLapp for a potential director candidate as the activist investor continues to seek changes. Obviously, when you're thinking about some of the issues that the French fry supplier has had so far this year, if you want to look year to date, though, that stock's still down about 38%. So it is on pace for its worst annual gain this year. But that is among some of the best performers today, even though we did see earlier this month, actually, the company actually ended up cutting its profit forecast and replacing its CEO. So that is one of the bright spots today, ladies.
You know, one of the stocks I'm keeping an eye on, of course, also is Palantir, because this has been a huge gainer heading into this year, taking a breather today. Any real reason why?
So that's great, too, because also it just got added this month to the NASDAQ 100. So when you are looking at that stock, actually the third worst performer right now in the S&P 500, PLTR is the ticker symbol on this, down about 3.7% right now. So actually, when you're looking at this, it's kind of falling in sympathy with some of the other big tech names in software companies that we have seen giving back some of those gains going into the weekend. So right now, if you're thinking about also, I mean, that stock has gained more than than 300% at a certain point for this year too. So actually it's up 360% year to date. So kind of like going into the year end right now, you're starting to see some investors take some of those profits. But then also if you're looking at the multiples, the price to projected earnings were around 150 times. So that's another factor kind of going in, giving some potential excuses for people to sell with more in sympathy with some of the software stocks that are selling off today.
Well, another one selling off, but it for sure will not be unhappy to see the end of this year is SMCI. It had a storied year. It's possible some of its problems are behind it, but it really had a difficult year, Jess.
That's right. And a lot of those different accounting related type issues, you're looking today down almost 5% here. And also if you're looking year to date, still up about 13%. But of course, it did get added to the S&P 500 back in March. But actually, I was looking at StockTwits, and it's one of the most named stocks, actually up close to about a percentage point compared to yesterday. So that's something that's getting a lot of chatter among sort of the chip makers today on StockTwits.
What about Red Cat Holdings? That's another one I know you're keeping an eye on.
I want to bring that up, right, because that's one of those companies, I mean, it does have a market cap below 1 billion, Chanel, so I wanted to point that out, but RCAT is the ticker symbol for this company, and also it's down about 10% today on pace for its worst day, actually since December 18th, so that would be the Fed day when we had the meeting where the stock market in general with the S&P 500 was down roughly 3%, but actually, if you look at this is a drone-related type stock, so it's gained 1,300% year to date. And so it's also been on a tear this month amid a broader rally in that particular industry just because of what's happening with the different drone sightings across the Northeast. So you are seeing that, though, reverse and give back those gains after what's been a significant rally this year.
They're not drones. Has no one told you yet? Not at all. Carnival, another place where people go to, have fun. Carnival stock down today, but it's also had quite the year.
It has. CCL as the ticker symbol on this. So down about 2.5%. And to your point, when you're looking on a more annual gain here, especially with the travel stocks, also when it comes to airliners too rallying, but this stock is up around 35% year to date. So actually Bloomberg Intelligence, their analyst, Brian Egger, he's the gaming industry there. So he actually was looking at how when you're looking at a large cruise capacity market share, that a lot of these are maintaining higher margins when it comes to that than compared to some of its rivals. So that's something that has been supporting that stock. Obviously, we're seeing it lower here. Some of the concerns about some of the downgrades that stock has had recently, but again, something that's been performing pretty well so far this year, ladies.
You know, it's interesting because I was taking a look at some of the biggest gainers of the day, or of the year rather, and it's interesting. Vistra was the biggest gainer on the S&P 500.
Yeah, and that was AI too, wasn't
right,
it?
It was.
Yeah.
And that's a big play. And also it was added to the S&P 500 recently, or would have been NVIDIA, but now that you have the data center businesses also tied to kind of the utilities play here, that's why that stock's actually up well over 100% year to date. And that's something that's been on quite a tear this year.
And then, of course, the other one I was looking at today was VeriSign, because Warren Buffett, Berkshire Hathaway, upped its stake in VeriSign, and that tends to have an impact on a stock. It happens to be not benefiting too much today from it, but that didn't stop Warren Buffett's Berkshire Hathaway.
Guys, I also want to just point out another piece of news here crossing the wire. Pretty interesting, because I want to talk about Big Lots, because this is a company back in September said it filed for Chapter 11 bankruptcy in Delaware and had sought to sell. It tried to sell to Nexus Capital Management, but the sale had fallen apart. It now is saying that it agrees to a sale transaction with Gordon Brothers retail partners, and what it'll do is transfer assets to other companies, including Variety wholesalers. So that it would include more than 400 retail stores owned by Variety retailers, now absorbing more of Big Lot assets. Really interesting moment here, because if you look at one of my favorite screens on the terminal, because I cover a lot of credit markets here, is BCY. Those are the bankruptcy filings that you would see in a year. And Big Lots this year was the third largest bankruptcy filing by assets in the United States. It was the fifth largest by liabilities. So certainly pretty large here, only to be followed by, for example, Spirit was another much larger one. That was the biggest by assets. There were a lot of bankruptcies, for a lot of pain in the consumer discretionary sector. Yet when you looked at the S&P 500, interestingly enough, that is where you're seeing the largest bid come in. I guess only the largest will survive, I suppose.
Yeah, I mean, you've got some of those that are teetering as well, like, for example, Container Store. I feel like we need to get Mr. Beastock back on the line. He might have something to say about all this.
Jess, we thank you so much. That is Jess Menton of Bloomberg News, looking at what's been moving under the hood. We're going to bring in now Anthony Saglan-Bene. He's the Chief Market Strategist for Ameriprise Financial to talk more about these markets. You are seeing a tough tape today. You did not see that Santa Claus rally maintain itself. What do you think this means in terms of the risk appetite heading into 2025?
We've had a really strong year, so I'm not surprised that investors are getting ahead of taking a little bit of profits, getting ahead of some rebalancing that we're likely to see through the beginning of next year. But I think we have to take, the declines that we've seen over the last couple of days, especially today, in the context of what we've seen all year, right? Very strong markets, a strong economy, strong consumer, low unemployment, profit growth continuing to tick higher for a broader set of companies outside of technology, and it's filtered through to the broader market. So not surprised that as we get to the end of the year, investors are rationalizing their portfolios a little bit.
So Anthony, we've made our money on AI. We're very happy with all of our gains. This is the hypothetical portfolio. What's the theme for next year? What do we jump on now and get ahead of the pack?
Yeah, a couple things. I think obviously big tech and AI has been the story of 2024. I think expectations are really high for that group, say the Magnificent Seven. I think it's going to be more about delivering on earnings expectations, which are very high, which could create some volatility for those particular stocks. I think the long-term secular trends are built into some of these companies, and so if you are underweight those areas in your portfolio, hard to imagine if that's the case, but if you are, take advantage of some of those opportunities where we get volatility. But I think outside of those areas, I think you need to be more selective about the securities you own. I think you need to look at industries versus sectors. So examples of that would be capital markets or software within technology and financials. And shareholder yield is a theme that we've talked about in our Outlook report. Focus on companies that are delivering shareholder yield. What does that mean? Raising dividends means returning capital to shareholders through buybacks. These are the areas that can help insulate some of that volatility and maybe expand your portfolio into areas that might benefit next year if we do see a little bit more volatility.
There is a sector I still want to ask you about. We were talking about consumers, and you keep on seeing from the data and from investors here feeling that the consumer is strong. You saw after the election when the market exuberance took off that the consumer discretionary sector was one. And by the way, I should say that Tesla is included largely in that sector as well. But even without Tesla, you did see a bid in a lot of retailers out there that would count as discretionary. What do you think happens from here, especially given that investors are now recalibrating the interest rate dynamic that could stay higher for longer?
Yeah, I think it really is. I think the key for 2025 is the consumer. The consumer has been very strong, little fragmented on the higher end versus the lower end, but overall we have very low unemployment. And as we saw in some of the shopping trends and data over the holiday, consumers are willing to spend. I think within discretionary, you probably have to be more selective there, right? Amazon and Tesla are big drivers of that overall index, and it kind of plays into the theme that we're talking about for 2025 is start looking at individual securities and industries that can benefit. And one of those areas within consumer discretionary may be retail, right? If our view is that the economy should grow around 2% next year, unemployment should be around that 4%, low 4% range. That means consumers have the wherewithal to spend, which means some of these consumer discretionary companies can benefit. You have to look at well-run companies. You have to be more selective. That plays into some of the themes and kind of overall portfolio management that we've been talking about for our outlook this year.
Anthony, how are you thinking about ways of capitalizing on whatever policy changes we might see next year?
Yeah, a couple things. Obviously, on the fiscal side, I think valuations, S&P 500 is trading at about 22 times forward earnings. It's very expensive based on history. I think a lot of optimism has built into stock prices. Part of that is with the fiscal backdrop, potentially lower taxes for next year, less regulation, pro-growth, pro-business friendly environment out of Washington. I think all of that is already priced in, and we've been talking with clients and advisors, is that if we just extend the 2017 Tax Cuts and Jobs Act, that's really not stimulative. You need to see taxes kind of move a little bit lower if we're going to talk about growing the economy a little bit more. And on the same, on the other hand, you have tariffs and the potential of that being inflationary or slowing growth. And we've done kind of some analysis that if you see tariffs on China go up to 60%, you see tariffs on all other imports at 10%, that could raise inflation by 5 to 8/10%. And it could actually detract from GDP by about the same amount. So that's why you're seeing a little bit more guarded optimism and a little bit more uncertainty around that fiscal backdrop, because the benefits of taxes and kind of the headwinds of tariffs are what investors are going to enter 2025 with.
That's for sure. Anthony, thank you so much for helping us to navigate it, and we hope you'll continue to do so throughout 2025. That's Anthony Cyclin-Benny, Chief Market Strategist at Ameriprise Financial. Of course, it's not helping markets today. Very, very low volume, though. We're at like half of yesterday's volume, and that's, yesterday was already thin volume, so we should note that. So these outsized moves are outsized for a reason.
Exactly, because of that thin volume. But, it's interesting to see, because you are seeing that selling in the equity market. You're also seeing it, as we've been talking about, in the longer end of the yields curve. You're seeing in the 10-year almost at 462. The steepening trade, the 210 curve, has been a massive trade all year. You're now looking at a nearly 30 basis point inversion, or differential rather, between the 10-year and the 2-year. So some people made money if they stuck with it this year, Vani.
Yeah. Coming up, Airbnb plans to offer travelers a lot more for their vacations than just a place to sleep. We'll get details next. This is Bloomberg.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भला के चक्कर में मेरा ही बुरा हो जाएगा.
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're going to talk travel now this holiday season. We're going to talk about it with JetBlue CEO Joanna Geraghty, who joined Bloomberg Surveillance earlier. She says the company is mostly done cutting routes, but it will change flight schedules as needed to make the company profitable. She spoke exclusively to Bloomberg. Take a listen.
As we think about, the holidays, we think about the summer time frame, that's where I think JetBlue does its best, because we fly to some of these great destinations. Troughs are definitely more challenging. We've seen some pricing pressure in the troughs, and we've reduced a lot of flying in the troughs. So it's really about balancing out that year and making sure that, when demand is high, you're focused on trying to capture your share of that demand. And in the troughs, really reducing the losses.
So do you expect to increase fares this year?
We're hopeful that we can keep fares affordable that reflect the cost of service. It's more expensive to travel now because there are costs. Airport costs have gone up, labor costs have gone up, so there's meaningful inflationary pressure for the airlines as well. Our great food comes at a cost. When you start seeing the grocery costs go up, that means the food in an aircraft is going to go up too. So we're really trying to balance it and make sure that relative to the other travel out there, that JetBlue is an affordable fare for customers and accessible for a leisure customer.
Well, there's also been other constraints on the airline industry when it comes to getting the parts they need, comes to actually getting the planes they need to fly. And then next year, a lot of people are talking about, well, we might get tariffs, and potentially that might impact the supply chain. How are you preparing for all of that?
Yeah, I mean, JetBlue has a unique situation with Pratt & Whitney right now, and we have a number of aircraft sitting on the ground that we're paying for, but we're not able to fly because they're due for an engine inspection, and there's not enough capacity to do those inspections. So that's definitely a headwind for JetBlue. As you think about tariffs, it's a bit too soon to tell. I think the good news for JetBlue is we take a lot of our aircraft from Alabama, but, depending on how tariffs get put in, we do have exposure in Europe and in Canada because some of our aircraft come from there.
Of course, the JetBlue Spirit Airlines potential merger was blocked. Are you potentially thinking about going at it again in the next 4 years in this space, more mergers and acquisitions, because there might be a lighter regulatory touch in Washington, D.C.?
We're really focused on delivering our new plan, Jet Forward. We want to see JetBlue thrive as a successful standalone company. We have a brand that customers love. We've got a great product, a great service. We're focused on flying in the places that people know us. So we're really focused on our standalone plan, Jet Forward, right now.
Okay, so you might not dip your toes back into that space, but do you think that this is going to be a more welcoming administration when it comes to things like mergers and acquisitions?
It's hard to speculate because we don't know exactly what the plan is going to be, but it's hard to see an administration that's going to be worse than the administration we had around antitrust.
In the meantime, you have announced a number of changes in terms of the Jet Forward, including closing down certain operations in a number of cities. I believe that they are going to cut, you're going to cut some 50 routes.
Correct.
Is it done? Are there more to come?
The network is always something that's evolving, so the majority of the changes are done, but we're not going to rest on our laurels. If a particular market is not producing results, then we're going to take a good hard look at it, see if we can improve it, and if not, then we're going to point those planes to a place where we can make money. We've got to become profitable, and part of that has made the need to make some tough decisions.
JetBlue CEO Joanna Geraghty there. Sticking with travel now, Airbnb bringing new features for its big push beyond accommodations in 2025. Think fridge restocking, and you don't have to do it, by the way. Midweek cleaning, all these kinds of amenities that travelers have come to expect from a hotel stay, but not so much maybe from someone's guest house. Let's bring in Bloomberg's Dana Wollman for more. How much more is Airbnb going to charge you for a stay like this if you want your fridge restocked, if you want that midweek clean?
So Airbnb hasn't been specific on the details. We're expecting to hear more in the new year. But they're going to have to offer a wide range of experiences. As one analyst we spoke to said, the typical American consumer doesn't have that much money, that much disposable income, especially after accounting for all of Airbnb's usual cleaning and just administrative fees. So they would do well, and this isn't just me editorializing, but I think analysts would say they would do well to offer a wide range of price points. Not everything can amount to customers living like a king with in-home massages or what have you.
So why are they doing this now? Because it was roughly 8 years ago, as you guys have reported, that they ventured beyond lodging programs like experiences. So this seems like a large shift to be making at this point in time.
So Airbnb actually is going to be restarting its experiences business in the new year, and this follows a period of cleansing, if you will, where Airbnb was doing things like removing thousands of what it would describe as low-quality listings and trying to improve the fundamentals of the platform itself. And now that it feels it's done that, it can focus on adding amenities that help it better compete with traditional hotels. I would say, too, that something the broader travel industry has been seeing is that although travel demand among U.S. consumers has been a little soft lately in recent quarters, demand has remained pretty strong at the high end of the market specifically. And it seems like some of these amenities are chasing those very consumers who have some more disposable income, are less afraid to book travel further in advance, invest in these costly trips, and perhaps maybe also add on these fun extras as well.
How much of this is to get ahead of AI also? Because, you know, a lot of people now are looking at generative AI and saying, okay, this is a new way to book my next experience, find my next place to go, figure out how to get around a new location. Maybe it'll figure out a place I want to go that I didn't know I want to go. If Airbnb doesn't do this, do they risk being obsolete many, many years down the road if they don't get ahead of competing with Gen AI?
Generative AI is definitely on the mind of Airbnb executives, and it's something that they intend to pursue, but I think have been open about the challenges of what they would call the infrastructure before you can get into generative AI. How well equipped are you to set up that kind of complex computing processes, and how robust is the platform, the core platform itself? So I think it is on the mind of Airbnb executives, but in the meantime, this is a way to sort of curate experiences, not through artificial intelligence, but offer some form of special curation that, to your point, could maybe go alongside or go toe-to-toe with a more automated solution of suggestions.
I feel like this is also going to put it up to hotels. They'll have to up their service level as well, even at the most basic level of hotel, if Airbnb is doing this.
I think that's the idea, yeah, or at least part of the idea is to better compete with hotels, where it might be more common, indeed, to see these massages, airport transit, fridge restocking, all of that, albeit to different degrees depending on the kind of hotel that you're going after. But to that point about the bifurcation of the U.S. Travel market, there's the other end of it where consumers are trading down to lower-priced hotels, maybe staying less for shorter stays. So that could create a squeeze in the hotel industry, too, where they have to work harder to win and retain customers, especially at the high end.
Do we have any idea what this is going to add to Airbnb's revenue for a year, for example, or what its stated goals are, or anything like that?
I don't have the story in front of me. I think we may have thrown around a figure like, $1 billion. $1 billion. I wanted to say $1 billion. I didn't want to swallow my words later, but $1 billion is a big number, even by Bloomberg standards. Yeah.
Well, I mean, to that end, too, is this $1 billion right away or $1 billion over a number of years? It sounds like the payoff isn't going to be immediate, and not all the details are quite hashed out yet.
Absolutely. Not all the details are hashed out. And I too detected some caution in all the reporting we've done and all the interviews we've done with executives and analysts so far. I don't think anyone's expecting it to be an immediate solution or just an immediate injection. But
and it could also, welcome a whole host of difficulties, right? Imagine you've paid for that extra, bath salts to be there, and then suddenly they're not there, and then you're complaining to Airbnb, and you have a contract with Airbnb, not with, the provider, for example.
Now I'm imagining Vani complaining about the bath salts.
I'm the simplest girl. Just give me a tent. I'm fine. I don't even need an Airbnb. But yeah, I mean, has Airbnb? I mean, it's probably well used to handling complaints and disappointing consumers too.
There's that, and my first thought was that it's a challenge of scale. Think of all the markets where Airbnb operates, all the listings it currently has and would like to add in the future. And so I don't want to call it a problem, and I certainly it's not for me to call it impossible, but I think it's fair to call it a challenge of scale. How do you roll out these kind of amenities widely enough that people feel they can reliably count on Airbnb to book something like that.
Dana Wollman, we thank you so very much for your time, of course, covering West Coast tech for us here at Bloomberg News. You know, we are just less than 5 minutes away from the close.
I'm getting a little emotional. It's literally the last full trading week of the year, even though we're not quite full because we didn't have Wednesday, but we're in the red, Shonali.
We are in the red, and for the S&P 500, to the red by the tune of more than 1.2% at the moment. And of course, we might still end up on the week thanks to that Christmas Eve rally that we saw, but certainly a tough tape out there. We will bring you exactly what has been moving, the setup into the last week of the year. Just a couple trading days left, everybody. Stick with us. This is Bloomberg.
Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
We're scaling up at incredible pace.
This region is growing so rapidly. The opportunity is really huge.
Only on Bloomberg. Context changes everything.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
There is no backwards in recycling. There is no backwards in treating pollutants in the water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services, even in time of crisis, as well as to see the long term and deliver good result, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Welcome to a special TV and radio edition of Bloomberg Markets. I'm Vonnie Quinn.
I'm Shonali Basak. We are here at Bloomberg's headquarters here in New York City. We are looking at a down day, Vonnie, as the market marches to a close. Up week for the S&P 500, but certainly a lot of red on the tape on a thinly traded day.
It was a valiant effort in the last few minutes of trading. We rallied off our lows of the day and at the same time finished down 1.1% on the S&P 500. Similarly, for all of the other major indices, it was a red day. The Nasdaq 100 down 1.4%. The Russell 2000 suffering down 1.6%. The Philadelphia Semiconductor Index as well saw almost all but one of its components lower, and Advanced Micro Devices gave up most of its gains at the end. It ended up squeaking into the green just at the very end, down up 0.1%. Those chip stocks and those favorites for most of the year to blame for today's moves for the most part. Well, joining us now to break down those market moves, we have Alexandra Semenova and Natalia Knichevich. So, Alex, let's start with you because you've been looking at those gainers, and boy, did you have to look hard.
Indeed, Vonnie. Seemingly just a handful of names closing the session in the green today. One of them was Progeny. This is a fertility benefits company. Its executive chairman made a big purchase in the stock. He snapped up 150,000 shares worth $2.2 million. This is according to a filing, and insider purchases are, of course, a testament of confidence by management in a company's outlook, hence the upward move today. It's closing up about 15%, but despite being a bright spot in today's sell-off, Progeny shares are still down more than 50% year to date. Another name I have here is SESAI. This company is the maker of lithium metal rechargeable batteries for electric vehicles. Those shares are up a whopping 68% today and rising for the fifth straight trading session, by the way, coming off of a 100% gain yesterday. Why, you ask this move? No apparent reason. Kind of trading like a meme stock here, and its volume at some point surged to almost 130 times its 20-day average. And finally, I did have Arena Group as one of the stocks that was gaining today. Was up as much as 17% earlier in the session, but it looks like it took a hit as well today into the close, now down 2% in the final few minutes of trading. This stock earlier in the day said that it was notified by the New York Stock Exchange that its plan to regain compliance with listing standards had been accepted, hence the initial upward move, but again, falling with the broader market, not making it into the green at the very end of the day.
Scouring the earth for some green. We're also going to bring in Natalia Knichevich now for some of those decliners. What dragged down the indexes today?
Definitely Magnificent Seven stocks, and Tesla has been the second worst performer in the S&P 500. The stock is down by 5% today. Again, there is no fundamental reason, potentially some profit taken across different investors, but now all eyes are on fundamentals. Tesla is expected to post delivery for the fourth quarter next week. Investors will be definitely keep an eye on that, but overall, strategists, investors, analysts are pretty optimistic on the stock. I saw the latest note from Bloomberg Intelligence saying that Tesla earnings could top expectations by 25% next year, and that will be driven by less expensive electric vehicle cars, redesigned Model Y, as well as Cybertruck profit and expansion of profits coming from its battery storage unit. Now, I'm also looking at travel stocks because cruise line operators such as Norwegian or Carnival were also one of the biggest decliners today. Overall, again, there is some profit taken, but analysts are pretty optimistic about travel stocks, including cruise line operators. Those during the past earnings season raised forecasts, and when it comes to other parts of this travel sector, such as airlines, we saw a story today from my colleague Peyton Forte saying that this sector sees so much optimism. Airlines are expanding earnings projections going into next year. Nevertheless, consumers, this is the wild card for the next year. We should definitely keep an eye on how willing.
Natalia,
yes,
you watch positioning so closely from the street. You talk to all the prime brokerages. How much of this year-end kind of downturn that you're seeing, this ending of the Santa Claus rally, if you will, is profit-taking versus a change in risk sentiment?
That's a very good question, because up until recently, we saw that hedge funds posted one of the biggest returns in the past 4 years. They are in a pretty good shape, as people are saying that no one is forced to trade. So we did not expect some profit taking going into the year end. What I heard from sources that hedge funds are in a wait and see mode. Typically, January is a month when everyone is coming back from vacation. People are getting more active when it comes to increasing long and short positions. This time around, it looks like maybe hedge funds is also part of this play and profit taking going into the next year. But hopefully we will get some prime brokerage data later today during this weekend, because it will be really interesting to look at positioning.
Looking forward to
the market's
seeing all
closed.
that.
We don't work anymore, right? Once the market's closed, we stop working.
People are 24/7, as you know. The street doesn't sleep. Natalia, Alex Semenova, thank you both so very much for your time taking a look at everything under the hood. We're now going to bring in Davis Nelson. He's chief strategist at Bell Point. And it's interesting. I want to read a little bit of a note here from Louis Navalier, who said that today's selling was mechanical. The B team is in charge right now, and everyone's getting rid of their inventory just before the weekend. Shouldn't worry about the sell-off. Do you see this as just a little bit of inventory management, window dressing, if you will, rather than a full-off shift in risk appetite heading into next year?
It's probably all of the above. You saw 10-year yields at 462. That doesn't go unnoticed. I think a big part of this month is the insider selling that you were alluding to. Coming into just before the Fed meeting, before the Fed decision and that gap down, the Russell 1000 had 135 stocks up better than 50%, a couple of dozen up more than 100%, and two up over 500%. When you see those kind of gains, insider selling is going to pick up, and we saw it pretty big this month.
Right. I mean, if you're at these heights, we're under 6,000 now on the S&P 500. But yes, to the point you're making, a 10-year closer to 462. If you put your pen down heading into this week and didn't lift your head up until you walked out, you would have looked at that 4.6 level and not loved it very much in terms of what it means for some of the hottest trades into the market next year. Do investors start to recalibrate with that higher level of interest rate in mind going into next year? Is it going to start to matter more?
It does matter. It matters today. Most valuation models start and end with the risk-free rate. So as that climb, everybody has to recalibrate. Every bull market has its Achilles heel, and I would say the 10-year is that. If you think back to September, right after we had that first 50 basis point cut, back then, the perception was that we were going to get an additional 150 basis points of cuts between now and the end of the first quarter. Now we're going to be lucky to get just one. So you have to calibrate that in. It doesn't mean that stocks can't do well, but it means the hurdle rate is that much bigger and the earnings are going to have to be that much better.
So how much should you be in cash going into the beginning of a year that's going to be highly unpredictable?
I tend to run cash very, very low. Market timing is pretty tough. And what's going to be the catalyst to get back in? Is it going to be down 10%, down 15%? Down 10% is going to feel like we're on our way to 20, and most people will get back in at higher prices.
Do you rebalance at all, or where are you actually putting the bulk of your risk sentiment?
Yeah, that's really interesting. I'm expecting a fair amount of rebalance, at the start of the year. A lot of it's already happened this month. A little bit surprising. I think a lot of hedge funds are tagging on to the insider selling that they've seen. You look at companies like AppLovin, a very popular stock, up about 700% this year. You saw $4 billion in sales from insiders. That sparks a lot of selling. I'm pretty fully invested across most sectors. There's something to own everywhere.
And so you continue to own AI. You don't think there's any chance of a sell-off? And also, what about Bitcoin-related stocks?
I can't tell you that there's no chance of a sell-off. AI is still in its early stages, and I don't think you can paint them all with the same brush. What I'm looking for in the first quarter earnings reports, watch CapEx. Watch companies like Microsoft. Microsoft is expected their CapEx is about $67 billion. You can bet a lot of that is towards AI. If that starts to track lower, that will be code that demand is a little less than expected.
So you look at the sentiment under the surface, it's still pretty bullish, at least in the strategy world. You're looking at a long-held strategist like Ed Yardeni saying that the S&P 500 is going to hit 7,000 by the end of next year. Do you think so?
Predictions are pretty funny. Last year at this time, the predictions for the S&P were 48.33. That was the average. We passed that in 4 weeks. The high estimate was 5,200. We made that by the end of the first quarter. So a target it's a moving target. Markets are a living, breathing animal, and when the data changes, so will we.
So what does the data tell you now that you should do heading into 2025? You have January 1st, you have a clean slate. What do you do?
I have to stay fully invested. There's too many stocks out there that I want to own. What we can't do is throw away sectors. Whenever you massively underweight a sector that hadn't done well the year before, you get your head handed to you. You saw that back in 2020. Energy, everybody was selling it, and then it had the best 2 years. Right now, the lagging sector is healthcare. Nobody wants to own it. There's a lot of good names in there. We own several.
Okay, so earlier we were speaking to somebody who said obviously some healthcare areas like biotechnology firms, for example, are very binary. Something either works out or it doesn't. In healthcare, where are you looking? Because I know that there was a lot of nervousness in the community of healthcare investors when it looked like, and it does still potentially mean that we're going to have, a different HHS secretary.
On biotechs, I'll leave that to the experts because it's a binary move. Either it's a home run or it's a zero or down 50%. I can't play that game, so I have to focus on companies that are earning money. Key holdings for me right now are Cardinal Health, Concora, COR, and I believe we bought Vertex Pharma right at the close today.
Right, interesting. Where else, if you look at energy, for example, are you doing it via the AI play, so those companies that are taking care of AI energy needs or AI liquid cooling needs, or are you looking elsewhere?
Well, certainly you're talking utilities. Utilities is a slam dunk. I think it's one of the easiest trades right now. Right now, it's 2% of the S&P 500. I suspect in a number of years, it's going to be twice that. So there's a basket of names that you could own out there. NRG, Vistra, Constellation Energy are all names that we've been involved with on and off for the last year.
Well, Vistra's been interesting. We were talking a little earlier about how that has been the biggest gainer in the S&P 500. It has been just on a massive tear, up 262%. How do you beat that? I mean, if you've been holding it, do you start to trim a position like that, or do you expect anything close to that kind of gain next year?
Yeah, I sold that one too early. It was a home run for us, and we left a lot on the table. It's a name I'd like to get back in. If there is a rebalance at the start of the year, it's a name that could see some added selling. That would be one that I'd love to pull the trigger on.
All right. Well, next time, wait a little bit longer, David, and then see what happens.
I'll try to do that.
David Nelson, thank you so much for joining us. That is David Nelson there, Chief Strategist at Bell Point. And that's the tough part of investing and also the beauty of investing, right, Shonali? You get a right pick. And, we heard Stan Druckenmiller kicking himself earlier in the year about NVIDIA. Even as he could have got back in again at around $100, and maybe he did, maybe he didn't, we don't know. But that's the beauty of investing.
Well, if you're an investor like Stan Druckenmiller, and I don't think I could do this if I was an investor, I think it would be too painful to do. It's you watch what happens after you sell, and then you multiply the number of shares that you held by the differential and how much it rose, and that's
to torture yourself.
That's kind of the implied, money left on the table, isn't it? It's not a loss. You didn't lose anything there, but it is the opportunity cost, I suppose.
Yeah, it's a tough one.
That's the bull market's dilemma, isn't it, Bonnie?
Yes, indeed. Well, let's see what money gets left on the table after today's session. We do have 2 more trading days, don't forget, in 2024. As I always say, there's potentially lots of opportunity to make or lose money. Stick with us, though. We're going to be speaking about the business of sports next. A very interesting guest, Stephen Olnick of Mints, joins. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
Top names in business are on Bloomberg.
The question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. We got to realize that the impact we have if we don't get this debt back in line.
Nobody covers business like Bloomberg. Context changes everything.
Welcome back to our Bloomberg television and radio audiences. We want to bring you some breaking news because it's a highly watched story. TikTok versus the United States. TikTok is urging the U.S. Supreme Court to overturn a looming ban. They filed the brief in advance of the January 10th Supreme Court argument. We will be taking a look at exactly what they have filed here, but of course we are keeping an eye on that developing story because there has been a lot of political posturing around TikTok and its operating in the United States, Fanny.
Yeah, the Biden administration absolutely determined to get this done while Biden is still president, right? Scheduled to file that brief later today. In the meantime, Netflix says it sees the payoff from its star-studded Christmas NFL games coming right through. More than 24 million viewers tuned in to watch the games on the streaming platform, setting a new record for the league and even topping that of traditional broadcast networks. Joining us now is our star Hollywood reporter, Bloomberg's Lucas Shaw. So Lucas, 24 million viewers, not bad, but what were the metrics? How long did you have to be on Netflix? Because I will confess, I happened to just realize that Beyonce was probably coming on soon, and I tuned in for those 13 minutes or whatever it was. Do I count?
Well, you're the reason that viewership peaked during the Beyonce performance. I believe they said 27 million. I mean, they measured the viewership for Netflix much as they do for traditional television, where that 24 million is the average number of people that were watching at any given time. So you can basically assume that 24 million people watched the whole thing, right? Wow. There were more than that who watched at one point or another, but the average was 24. That's good, not great, I guess would be the answer. They were able to tout it as the most watched streaming football game ever, really streaming sporting event. It beat a playoff game on Peacock. At the same time, it was a smaller audience than watched Christmas last year, and is sort of a little bit bigger than the average NFL audience week to week, which you would expect on Christmas. But you have to imagine both sides are pretty happy with it, right? They were able to put a game on Netflix. There were no issues with streaming, and one imagines, given Netflix's global reach, that the international audience, which they'll release, I believe, next week, will be larger than it would have been otherwise.
Forever balanced, Lucas. We appreciate all of that from you. But also, just going back to the number itself, 24 million, yes, a good number by and large, right? So what does this mean for traditional streamers, given that you've seen Netflix kind of out of the bat, right, out of the gate here, bring in more viewers than you've seen in many traditional broadcast games?
Yeah, look, it is a good number. There's no way around it. I guess I provided both sides because I got text from people trying to sway me to one or the other, and I think you just take it down the middle. It's pretty impressive. You know, you mentioned them doing it out of the gate. You know, Amazon, its first year with Thursday Night Football, the numbers were not great. Part of that was people blamed on the matchups. Now this year in year two, the numbers have been pretty good. You know, Peacock did really well with its first playoff game. That's a playoff game. You figure people can find it. But yeah, Netflix has proven that it's not going to take it very long, if any time at all, to deliver an audience for sports because people are already going to Netflix to watch TV. And even if they're not used to watching sports on Netflix, they are used to searching in different places for sports because they already have to do that for football in a bunch of different places. And they're used to watching anything on Netflix. So it should be pretty seamless for Netflix going forward and is a bit of a warning shot for any future bidding, assuming Netflix wants those rights.
Lucas, we thank you so very much for closing the loop on this one. Of course, those numbers came out pretty stunning. That is Lucas Shaw. Don't miss him covering entertainment for us here at Bloomberg News. He has a newsletter that is a must read. Now, the Christmas Day games were not only big wins for NFL and Netflix, but for private equity firms looking to invest in some of the league's franchises. Joining us more on the business of sports, Stephen Olenek. He's member and chair of the sports and entertainment practice at Mintz, which helps provide organizations and individuals in the sports industry with counsel on strategic, transactional, and litigation issues. As you know, Bonnie, I've been covering private equity here for as long as I could remember. The NFL has been the most exciting thing.
Crown jewel.
Crown jewel.
Crown jewel.
Crown jewel. But how much better does it get when you have that many more options? If you have Netflix starting to stream the sport more, so much of the value of these teams are also contingent on the streaming rights.
100%. And look at the eyeballs that the Netflix got versus the NBA. Look at everyone wants to say which sport is king. Right now it's football. Look at it. Yesterday was Christmas Day was the actual day where people saw. Look at the viewership between the NFL and the NBA. It wasn't even close.
So what does this mean at the end of the day in terms of valuations, you think? And what I think is okay, you have private equity firm A getting into the NFL. You have Tom Brady being one of the first players finally buying in too. But if you're a player, wouldn't you want then equity in your team at some point? Does it get really complicated when you start to get down the food chain here?
Well, if you're as good as Tom Brady, look at what Tom Brady, he was able to structure with Fox with his deal, $375 million. But what he cannot do within that deal is obviously he has equity within the Las Vegas Raiders, right? So what he can't do, though, he can't actually say anything bad about the NFL or do anything, against the NFL because he himself now is an NFL owner himself, right? So if you think about it, all the players and all the professional athletes would like to one day potentially own a piece of an NFL franchise, to answer your question, because all these NFL valuations of the teams have skyrocketed, right? But the opportunity really isn't there because these NFL teams hardly ever allow, and it's such a small group of owners that could actually buy into such an asset like that.
Yeah, and also I don't think Tom Brady would have anything negative to say about the NFL if he was allowed. Maybe you can tell us the secrets later on, right? Yeah, exactly. Transfer window for college football playoffs between December 9th and 28th. So basically, this is the last day. It's becoming like a free agency window. How are you gaining clients, and what do you do for these clients?
Yeah, so look, you look at the NFL, you look at college football. It's becoming almost like the minor leagues for the NFL, right? So now you have a very small window of time where some of those student athletes opt into the transfer portal and basically are saying to the respective schools with the big money in their collectives, come get me.
Yeah.
So if you need a quarterback, come get me, because at the end of the day, they have the right to move. So in terms of what we do, you counsel them throughout. There's obviously regulations that you have to adhere to. It's a bit of the wild, wild west in terms of what the NCAA and the state laws and working with public schools versus private schools. So you really have to know the laws and the restrictions. But the student athletes gives them an opportunity to capitalize and monetize off their name, image, and likeness.
Is there anything concerning to you about name, image, and likeness deals post the Supreme Court decision, given that some people are just more popular on social media than others, and also, does it change the future in the sense that if you've made your couple of million or whatever your number had been when you were growing up, before you even leave college, do you then even bother becoming professional?
Great question. Well, look, if you look at these deals, if you're going to be a late round or mid-round draft pick, why wouldn't you stay in school where you are essentially the big person on campus? So why wouldn't you just structure a better name, image, likeness deal with the collective to actually pay you more than what you would receive if you were a late round draft pick, say in the NFL? So in terms of it, it gives the opportunity for a lot of these student athletes to capitalize on their name, image, likeness and find brand deals that can set them up for the future. But the one thing that we need to do is we need to put in guidelines and standards so that it's an equal playing field. Because if you can see, based off the college football playoffs, the big schools obviously are winning.
Stephen, we're going to have to get you back in the new year. We haven't got enough time to talk all this through, but it's so fascinating that Stephen Olenek, member and chair of the Sports and Entertainment Practice at Mintz.
Thanks a lot.
I do want to bring you some more details on that breaking news that Shanali gave you earlier. The Biden administration now urging the Supreme Court to uphold the U.S. TikTok ban. This just coming in the last couple of minutes, that brief obviously being filed at the Supreme Court. This is the whole idea that TikTok and the Biden administration are making dueling arguments to SCOTUS as a showdown, really, Shanali, over a law that would ban TikTok next month.
Yeah, a few more details from these briefs that are being filed. The main brief has been filed in this case, and the Justice Department is arguing that Chinese control of TikTok is threatening national security, which we have known that they've been concerned about. And this is by letting a foreign adversary spread propaganda and collecting data on Americans. That is their argument. TikTok and their parent ByteDance's argument countered by saying that the ban would unconstitutionally stifle the speech of 170 million American
users. Now, is it through the dances that they're doing this, or through the comedians? I don't know. How are they
stifling the speech, or threatening national security?
Threatening national security, yeah.
Well, that we will see being fought out in court, Vani. That is not up to us. Stick with us. We're going to switch gears. We're going to talk about the wine industry next. Of course, it is a Friday night. It's a great conversation. This is Bloomberg Markets.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भला के चक्कर में मेरा ही बुरा हो जाएगा.
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Bloomberg Markets, to our TV and radio audiences. I'm Shonali Basak alongside Vonnie Quinn. And many economists this year have raised their projections for U.S. inflation next year due to tariff concerns. And last week, I spoke with the CEO of Cisco, a giant food distribution company. He weighed in on the challenges that are facing his industry. Take a listen.
We're seeing a bit of a normal environment at the current moment. The challenge that consumers are facing is the following, Katie. If you look back cumulatively over the past 2 to 3 years, menu prices, when we go to a restaurant, are up about 30 to 40% versus 2019. So I think that's the pain that we're all feeling when we go to a restaurant. We at Cisco are taking actions with our supplier community and with our own book of business to help bring those prices down so we can help restaurants lower menu prices and still hit the profitability targets that those individual business owners are hoping to achieve.
Right. It seems like consumers who were looking forward to a spate of deflation are looking at a December even alone where cocoa, coffee up almost 40%, more than 10% respectively. And if there is something you could do to bring those prices lower, what exactly is it at the end of the day? Or do you simply just see consumers shifting their preferences to goods that are cheaper?
Sure. That's a great question. I appreciate it. And we view ourselves as a part of the solution, not the problem. And we have a 4-part plan, if you will, to help decrease the pain that consumer is feeling when they go out to eat. First and foremost is to work with our supplier community to bring down costs. We are the largest purchaser of food in the food away from home segment. So leaning in hard with our suppliers to help them be more efficient, be that how we buy, the frequency that we buy, creating competitive environments to have suppliers of like product compete for our business so we can get to a lower net landed price and again pass that value and savings on to our end customers so they can lower menu price. Step 2 is Cisco brand. We offer a private label product under the Cisco banner, and that product is very high quality and it enables our customers to save money. We say save them time, save them money. It may surprise you that 50% of what we sell to a mom and pop independent restaurant is a Cisco branded product. And we can lean in harder there. We call them swap and save opportunities. Make it clear on our ordering website, make it clear through our 7,000 person plus sales force to share that value with our customers, to educate them. If they swap, they can save. Thing number 3 is to take time out of the kitchen, help them with the opportunity to take labor costs out. So we have prepared foods and the like that we can lean in by cutting the meat in advance of it arriving in the kitchen, cutting the vegetables in advance of it arriving in the kitchen. And those prepared foods are a good opportunity for our customers to take labor costs, because those are the 2 things that have increased the most for a restaurant. Their food costs are up, their labor costs are up. We can help with providing both of those opportunities. And last but not least is lower cost alternatives. If one protein category is spiking, we can help that customer understand, make the following changes to your menu. You can shift your consumer purchasing to a lower cost of food, helps the end consumer save money, helps that restaurant lower their food costs.
The CEO of Cisco there speaking with Shonali on Bloomberg's Open Interest. Well, another industry facing the pressures of inflation, wineries. But one business hasn't changed their prices in the face of escalating costs, and that's Boich Family Cellars. Joining us now to discuss is John Boich, the founder of Boich Family Cellars. So, John, tell us roughly how much wineries have had to put up their prices and how you've managed to not put up your prices.
I'll tell you, thank you first off for having me. Delighted to be here, and happy holidays to everyone. It is a very busy season here in Napa right now. Gathering and celebrating is typically very good for our business, and we're enjoying all of the visitors that come to participate and celebrate in Napa this time of year. It's a lot of fun. You know, when it comes to the global perspective, supply, demand, and prices, there's a bit of a dichotomy going on at the moment when it comes to those three dynamics. And you have to think about it in terms of dichotomy based on price points. There's the ultra luxury segment of the wine industry, and then the more commodity segment of the wine industry. And if you look at the ultra luxury segment, where Boich Family Cellar resides, very resilient. We've got volume and price still trending up in single digits. It's a healthy industry. Conversely, if you look at the commodity segment, it's a bit of the opposite. It's a bit soft. I would call it stabilizing, but volume still declining with moderate pricing. The pricing bit around the pandemic, I have to say, was quite a unique dynamic. We can get into that a little more if you'd like to.
Well, maybe you could tell us what is considered luxury in this market, because we know people have been trading down for other goods, right? Have they been trading down for wine?
So here's a couple of, if you sell wine that costs $200 or more, you are in the top 1% to 2% of wines in the world. And those wines are typically very supply constrained because they come from world-renowned vineyards that are in finite supply. If you sell wines that are less than $100 or perhaps less than $50, you're into a very big market. I mean, in America, that's 330 million cases of wine a year. What happened during pandemic, 2020 and 2021, is we had this enormous surge in volume. People raised prices, people stayed home, bought a lot of wine to be shipped to their house. Some producers increased production. A lot of producers increased price, 20 and 21. So when you see prices down in 22 and 23 and a little bit of 24, all that is in the commodity segment is a little bit of reversion to mean, like any market.
John, one thing I've been wondering about is when you think about next year, we have this story out on Bloomberg.com right now talking about the impact of tariffs on countries that are importing wine to the United States, or exporting wine to the United States, rather. So if you have, for example, European winemakers that are trying to get ahead of any potential moves by the U.S., what does that dynamic potentially look like heading into next year?
You know, again, I think you have to look at the segments. So for us, it's not an issue. We make 1,500 cases of wine in America in Napa Valley and sell to 3,000 customers. So that's one dynamic. If you're dealing with, say, first growth Bordeaux wines, I think we all know who those people are. So this is Lafite, Latour, Chateau Margaux, Haut-Brion, Mouton Rothschild, right? Collectively, those 5 first growth vintners make about 100,000 cases of wine. So again, not an issue. There's this chronic supply-demand imbalance that typically gives them pricing power. But if you're not in that category, if you're in the commodity category and you're exporting wine from Europe to America, you're going to have to be really on your toes about it, because there is a bit of a supply-demand imbalance in the commodity section of the wine. If you were to apply tariffs to that going into 2025 and 26, you're going to have to be ahead of that when it comes to your supply, managing your production.
So what does this mean in terms of different price tiers as well? When we think about next year, a lot of people are preparing for potentially some of the cost of the goods they're buying to be rising. But in wines, like in many parts of the economy, you may see a bifurcation. People who are buying bottles of wine that are in the 10s, 20s, 30s may be more sensitive than the people who are buying $100 bottles of wine or more. So if you are at that upper end, do you think prices can still go up quite meaningfully from here for more high-priced wines?
It's amazing. Well, the answer is yes. And the reason is because we have had a tremendous correction from, I would say, really outsized price increases during pandemic. One thing that happened during pandemic is demand for wine, especially wine that can be shipped to you, went up a lot, like 4 times normal growth rate in 2020 and 21. Producers took advantage to raise prices around that. In some cases, 30 to 40% in a 2-year period. Unseen in history. This was the pandemic effect. What's happening since then is we have had a moderation of prices in 2022, 23, and a little bit of 24. That's why I refer to the stabilization. So I do believe that even in the ultra luxury segment wine, where people raise the prices a lot, they're going to begin to have more pricing power. We didn't do that. At Voitsch, we did not increase our prices a lot. We have inflation, like everyone else. We work that into the price of our wine, and our customers appreciate that because you don't see a 25% increase in a bottle of wine over the course of the year. Maybe it's 5, maybe it's 6, right? Thereby, you will see volume stabilize and go up, and a little more pricing power creeping into the equation, which will be a very welcome development for the commodity wine producers.
John, it does strike me as we talk so much about the potential for tariffs this year, we've been speaking about it constantly, particularly since the election, that one area where tariffs might be welcome is wine producers, right? So if there are extra tariffs placed on European wines or French wines, does that benefit Napa?
A little bit, but the numbers are so minute. I mean, again, we have 75 million wine consumers in America. And in Napa Valley, we make about 100,000 cases of ultra premium wine. So you can kind of quickly do the math. So with or without the French wines in America, our wines and wines in our category sell out every year, and they have a wait list. So it's a bit of a different discussion when you're talking about that category. But America, I love to share this statistic because America, consistent with its zest for consumption, pre-pandemic, consumed 1 million cases of wine a day. Wow. Specifically, 369 million cases of wine in 2019. We're down from that a little bit in 2024, but it's still a huge number, and we are by far the largest producer of wine in the world. So if we have to pay an extra 10% for a bottle of Barolo or French wine or whatever we love, my sense is that Americans will do that.
John, we thank you so much for joining us. Happy holiday season to you. Happy New Year. That is John Boysch, the founder of Boysch Family Cellars. Of course, conversation about the wine industry. I want to shift gears now and bring you some breaking news as well, because there's a letter that's been sent to members of congressional leadership regarding the debt limit. You have Janet Yellen urging the Congress to take the steps needed before the Treasury would have to start taking extraordinary measures. She respectfully urges Congress to act to protect the full faith and credit of the United States. She said that the Treasury does not expect that it will be necessary to start taking extraordinary measures on January 2nd to prevent the U.S. from defaulting on its obligations. However, the Treasury currently expects to reach the new debt limit between January 14th and January 23rd. And of course, we know, Vani, in the middle of that is inauguration.
Yeah, it's a striking letter sent to the Speaker of the House, who also could change at some point, right? But it is a letter suggesting that now Janet Yellen, who has done the math, expects that the Treasury will reach the new limit between January 14th and January 23rd.
Now, we want to bring you some more breaking news as well. You have the president-elect urging the Supreme Court to pause the law threatening the TikTok ban. This is becoming quite the dramatic afternoon, Vani, because we know that we have currently the Biden administration and TikTok sparring at the Supreme Court over that TikTok ban. You had just a little earlier the Justice Department filing its main brief in this case, and TikTok and its parent ByteDance countering that ban that they say would unconstitutionally stifle the speech of 170 million American users. The president-elect now weighing in as well, urging the Supreme Court to pause the law threatening that TikTok ban. We'll bring you more updates as we have them. But before we leave you for the day, we're going to talk about the record-breaking holiday travel. Stick with us for the travel destinations of 2025. This is Bloomberg.
There is no backwards in recycling. There is no backwards in treating pollutants in the water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services, even in time of crisis, as well as to see the long term and deliver good result, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
We're scaling up at incredible pace.
This region is growing so rapidly.
The opportunity is really huge.
Only on Bloomberg. Context changes everything.
And you're watching a special radio and TV edition of Bloomberg Markets. I'm Vonnie Quinn, along with Shanali Basak. And while we had a down day for sure in the United States, it was a record year for travel, pushing airline stocks higher for the year. 60% higher, that is, in 2024. And that beats the S&P 500 by the most in a decade. Bloomberg's Jess Menton joins us now. And Jess, why do the airline stocks get such a boost when I feel like all I heard all year were complaints about the airlines?
And especially because of the underperformance that we have seen in recent years, especially coming out of COVID and the pandemic, and obviously trying to deal with certain grappling with higher, at what point when it came to oil prices in prior years. But we've seen, especially since this summer, and if you just look at WTI futures for where U.S. Oil prices are trading, that's still near the lows of the year right now. So you've actually seen American Airlines, for instance, earlier this month, as well as JetBlue and Southwest. They actually boosted their profit forecasts. American in particular for the final 3 months of this year, just because of what they've seen with, even though we've seen some of the stickier numbers with CPI and other inflation metrics, overall, when you're kind of looking at what's happening with oil prices, as well as inflation still ebbing overall, that really helping, and especially also with Thanksgiving and then the holiday travel season, if you're looking at the TSA numbers, record numbers there for travel, so that's obviously helping the airliners.
Yeah, it's interesting because the airliners have certainly had, many of them at least, some have not had the same fate as we know with Spirit, but others of them have had a very good year. It's not just them, though. You've seen very solid performance of many of the cruise liners as well and many hotel chains.
That's right. So it's really been broadening out. And so George Ferguson over at Bloomberg Intelligence, he leads the aerospace and defense analysis for BI. So they were looking at the outlook when it comes to 2025, particularly when you're thinking about the North American airlines. So obviously American, JetBlue, Southwest, and others, United. So they're actually looking at more focusing on moderating capacity growth, especially from low-cost carriers like Spirit, like you were mentioning, Shonali, but then JetBlue as well as Southwest. So that could potentially slow airfare declines there. That's what they're watching. But it could also support U.S. airline profits in the first half of next year. But something to keep a close eye on, obviously, wage costs and how those will keep rising, especially when you're thinking about labor groups, especially pilots receiving those annual increases in the mid-single digits, what that could potentially mean for those airline carriers.
Jess, we thank you so very much for keeping an eye on what's been a hot sector. We're going to talk more about holiday travel trends with Becky Blaine. She's the senior newsletter editor at The Points Guy. And of course, airline points here, card associations have been a huge part of the story. How are people faring this holiday season and taking advantage of the deals that are out there?
So I think we've seen record travel this holiday season. We saw it over Thanksgiving with the end of the Thanksgiving holiday, December 1st. TSA screened over 3 million passengers. So travel only continues to grow. We've seen, 2.7 million passengers every day so far, almost on this Christmas holiday break right now, with 2 busy days of travel still to come on Friday and Sunday. So with airfares lower, 6% lower than previous year, that people are absolutely taking the advantage of the opportunity to travel and trying out new destinations, but also staying longer than maybe they would previously.
Yeah, how is the return to work affecting things around the holidays? Because I feel like return to work is all very well and good until the holidays, when companies do have to be a bit more lenient than they did pre-pandemic.
Yeah, I think because of the opportunity for people to work remote or have a hybrid type schedule, we've really seen the airlines take notice of that also, and they've changed some of their route schedules to accommodate that. So what used to be the busiest day of travel, maybe during the week of Thanksgiving or during the week of Christmas, is not necessarily the case, and the travel ends up being metered out a little more evenly across multiple days during that holiday time frame, instead of everybody trying to fly on the day before Thanksgiving and coming home on that Sunday after Thanksgiving.
You think about the price consciousness now, and there is, of course, an element of, okay, Thanksgiving holidays, Christmas break, you are watching people go more locally to their family often, but you also have those people that are trying to capitalize on those luxury vacations as well. Do you see more people traveling internationally, or is that sting of inflation still keeping people closer to home?
I think it all depends on the destination, and with the strong dollar, then people can go to destinations that really get more bang for their buck. I mean, I personally was just in Portugal, and it was an amazingly inexpensive vacation, and used points for my airfare. So there are opportunities to travel overseas, and TSA estimates over 50 million people will pass through checkpoints. So we're really seeing that strong travel intention, and there is a rise not only in domestic travel but also that international outbound travel as well.
Well, and the dollar really helps, right? It seems like the dollar is stronger versus a lot of currencies right now, and of course inflation has been eating away at the United States, so it doesn't feel as bad spending your dollars because they're being eaten away by inflation anyway.
Yeah, and the one thing we have seen is the rise in the luxury hotel prices, which is where points and miles come in, as a great opportunity to be able to take advantage of a redemption that maybe there was a $900 a night hotel rate, and you can get that maybe at a Hyatt for 18,000 Hyatt points per night. So that really is the opportunity that people should be looking for, is where can they stretch their travel dollars and their points and miles further.
When you think about the prices that people will be paying heading into next year, where is there kind of the most concern? Is it what you're paying for a flight versus what you're paying for a hotel? We were talking a little earlier to one of our editors about the new offerings being put forward by the likes of Airbnb. Is competition going to drag prices down a little more when it comes to where you stay?
Yeah, I think that Remains to be seen on the pricing, but there is definitely, like you said, lots of competition coming online in the market, especially in the luxury sector. And then we've seen also this growth in some of this, glamping opportunities also between Hilton and Hyatt taking over traditional glamping brands and adding that to their portfolio. So I think what we would consider to be a traditional hotel brand is really looking to diversify their offerings. I mean, you look at some of the new brands that have been rolled out from select service all the way up through luxury, and some of these hotel companies have 30 different brands now. So there really is a type of accommodation for every traveler, and they're really trying to stay competitive in the marketplace. It also depends on the location. I personally live in Arizona. We have a very high concentration of luxury resorts here in our state. And, I think Dallas, that market has also seen a very high concentration of luxury and mid-tier hotels coming online for conventions and things like that as well. So it just depends on the market, but it also looks like the travel industry obviously is going to continue to grow, and the demand is not slowing down.
Becky, one or two words. What is the top destination that you're finding is for 2025? We're curious as to what the new place to go will be.
Yeah, Tokyo has been the most searched destination, and actually Japan is tops on our list for 2025 as one of the best places to use your points and miles. They've had a lot of luxury hotels come online in this last few years, and so there really are some beautiful new properties to check out and amazing, great opportunities to travel and experience the culture.
Becky Blaine, thank you so much. That is Becky Blaine, Senior Newsletter Editor at The Points Guy. Hopefully we'll be able to take up some of her advice in the coming 12 months. Just to reiterate that news that's breaking this late Friday, President-elect Donald Trump asking the U.S. Supreme Court to pause a law that would ban the TikTok social media platform on January 19th if it isn't sold by ByteDance, its Chinese parent company. Trump saying in the last few minutes that filing going through that the court should give him time after his January 20th inauguration to pursue a political resolution of the dispute. He didn't take any kind of position on the constitutionality of the disputed law, which Congress enacted on a bipartisan basis earlier this year. And of course, Shonali, this comes right on the heels of the Biden administration's filing to the Supreme Court asking it to uphold the law.
It's incredible. This comes within hours of the main filings that the Biden administration's Justice Department had filed for the Supreme Court, as well as the company's own answer. Remember, TikTok and ByteDance, its parent company, had countered that a ban would unconstitutionally stifle the speech, they say, of 170 million American users, while the Biden administration is contending here that this is a national security concern, letting a foreign adversary spread propaganda and collect data on Americans. So certainly, this has been a bipartisan issue, but we are seeing the president-elect now weigh in.
Can I just say, in the last few minutes, we've had news to take us right through the inauguration, because not only do we have this TikTok tit for tat, but we also have Janet Yellen telling congressional leaders that the Treasury is likely to hit the new debt limit somewhere between January 14th and January 23rd. And we know what comes in between those two dates, and that's the inauguration itself. And President Trump, not a fan of the debt ceiling, let's put it that way. All right, that does it for us. From me and Shonali Basak, have a wonderful weekend. We'll see you for 2 more trading days this year.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that it travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भला के चक्कर में मेरा ही बुरा हो जाएगा.
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always